shed some exposure at a time when it still is unclear how quickly some of that can be monetized.
Yeah, I think the AI number that they gave in the cloud segment, which they quantified, it's almost high single digit, 10% of their cloud revenue. Microsoft said the same last quarter. So to me, that clearly shows they are gaining in cloud. And look, when it comes to how market perceives their LLM leadership, they will realize over time that this company's underlying assets are a big moat that nobody can supersede. And look, right now, CapEx is a big focus. You will see that with Meta when they report. If they raise the CapEx, the reaction will be negative. So that's what the market is focused on, is if you're raising CapEx, that's lower free cash flow. And that was a reaction.
This is important for next week. Are you saying this is going to be punished next week when we hear from those other companies?
Absolutely. With Meta, and most likely they will raise their CapEx. They just released their latest version of the Llama model yesterday. And Mark Zuckerberg said he wants Llama to be the most used AI assistant. Guess what? They will raise their CapEx. And I think the market reaction will be negative.
There is this larger question kind of hanging over this reaction, which is, are we overestimating how quickly artificial intelligence can be applied and monetized? Is this sort of an implicit understanding that's been priced into markets prematurely?
I mean, right now, we don't know if the larger models, so GPT-4, let's say it took $200 million to train. Will GPT-5 take $1 billion in CapEx to train, or will it be along the lines of GPT-4? And will GPT-5 have sufficient, improvement in terms of, if you compare it to GPT-4 reasoning? If that is the case, we keep going higher in terms of CapEx. So until we hit a cap in terms of, the model improvement, the CapEx will keep going up.
When you look at YouTube in the next 100 days or Meta, what are you seeing in terms of advertising spending? So we had an analyst on yesterday from BNP Paribas who was a little bit uncertain about advertising because of how toxic really the political environment has become.
Well, typically in an election year, political ads are a tailwind for all these internet platforms. And I expect the same. The question here is, brand ads was weak for YouTube, and you have to ask, what are the verticals that didn't spend? They called out retail and financial services as verticals that did increase their spending, but maybe other verticals in the economy aren't spending as much on ads. So to me, this is a barometer of how good digital ad spending is, and typically lower inflation is good for digital ad spend.
We just wanted a final word from you on the cybersecurity startup Wiz, basically saying no to Google. Typically, we think about M&A in this particular part of the world breaking down because certain people in Washington, D.C. don't want it to happen. What's the kind of signal that you take away from the fact that it was the startup saying, no, thank you, we're going solo?
I mean, this was just a case of bad timing. Had the CrowdStrike outage not happened on Friday, we would be talking about a deal going through, literally, yes. Just because it makes sense. Google had the best shot of making an enterprise-related acquisition, and cybersecurity actually complemented their cloud offering. And I think regulators would have let that through, but clearly the company said no because they think they can garner a higher valuation.
Do you think they can, based on what happened with
If they were to go
CrowdStrike?
public in the next 3 months, they would.
Amazing.
Just because I think CrowdStrike will be losing business right now.
Amazing. Mandeep, thank you, sir. It's good to see you. Mandeep Singh there of Bloomberg Intelligence on the latest for tech, with a little bit of a sneak peek, a preview of some of the big names reporting next week as well, with Meta Bramo on deck, alongside the rest of them, Microsoft, Amazon, Apple, and pretty much everyone else.
And I wonder if maybe the signal that we can get here is to look at how much share prices have gone up so far this year and then determine how high the beat and raise has to be in order for those shares to pop following the earnings, because right now you're looking to a lot of positivity being baked into Google shares. How much is that really what's being punished more than the actual earnings, which actually beat expectations?
In the pre-market right now, Alphabet down by about 3%, Meta down by about 2%, and to your point, over the last year, those stocks absolutely flying. Coming up next on this program in the second hour of Bloomberg Surveillance, we'll catch up with Kate Moore of BlackRock, Aaron David Miller of the Carnegie Endowment for International Peace, Stephen Trent of Citi, and Winnie Caesar of CreditSights. If you are just joining us, equity futures on the S&P 500 pulling back by 0.7% on the Nasdaq by more than that. Yields just a little bit lower. We're down about a basis point in the 10-year at 423.88. And once again in foreign exchange, the dollar is weaker against a stronger Japanese yen. 3 days of this, dollar yen right now pulling back to 154.53. From New York, this is Bloomberg.
the linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Fed is late. They need to be cutting already. They should have started cutting some months ago. So, yeah, we're pretty aggressive on this, but it's really driven by the inflation forecast.
Inflation is gradually trending down, but we'll have likely a few bumps along the road.
The Fed, I think, has changed the balance with regard to how they're looking at things. And I think that the market is catching onto that.
The contrarian bet really that we have is that if the Fed cuts in September, it wouldn't necessarily be a good thing.
The problem in the short term is that we've priced in the rate cuts and the economy slowing.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City for our audience worldwide. Good morning, good morning. Here's the price action you're confronting this morning. We're down about 0.75% on the S&P 500, on the NASDAQ 100, pulling back by 1 full percentage point. The price action, disappointing relative to the numbers from the likes of Alphabet, which weren't bad. Tesla, the numbers not great. That stock is down by about 8% in the pre-market. The story I want to talk about is on the Federal Reserve and a big change from a former Fed official. The former New York Fed president, Bill Dudley, coming out and saying, "I've changed my mind. The Fed needs to cut rates right now. It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk."
Which raises the emphasis on jobless claims on Thursday, because he points to the labor market in particular that has increasingly weakened, at least in terms of the peripheral data. We're also seeing housing data yesterday coming in pretty negative. And right now we're seeing markets price in almost a 100% chance, 96% chance of a September rate cut. Will that get brought forward? Right now, the market's saying not likely.
Bill Dudley also talking about the bifurcation in the U.S. consumer. He's talking about those on the lower threshold. The rest have generally depleted what they've managed to save from the government's huge fiscal transfers, and they're feeling the impact of higher rates on their credit cards and auto loans. Housing construction has faltered. This is why he really thinks that they need to cut rates. The steam, all that tailwind coming off the U.S. fiscal spending has dried up.
You can identify the cracks. You mentioned housing. Let's build on that. The numbers that came from Redfin, a brokerage, with some data just yesterday. Nearly 56,000 home purchases were cancelled last month. That's equal to about 15% of all homes that went under contract that month. The highest share of cancellations for June in the brokerage's data going all the way back through 2017. Can't miss that.
The reason why it's so important is because of the speed. That suddenly people enter deals that they want to break. Why? Because of, quote, minor issues, because of the monthly costs associated with buying a home today versus their overall expenses. Meanwhile, we also get news this morning about the Blackstone mortgage REIT actually cutting their dividend. This follows cutting the dividend of KKR and Ares funds of similar ilk, as property values, particularly office property values, plummet almost 40% since 2022, according to some data. So you look at all of these headwinds and you wonder how much has actually come to the fore and how quickly could weakening happen as some of these shoes just start to, loosen up a little bit.
From Redfin, what stands out to me is house hunters are having trouble committing because buying a home is more expensive than ever. This is why the former president told us in that Business Week article that they should not be cutting rates before November, because this is an election issue. Mortgages, the fact that people cannot get on the housing ladder because it's just too expensive. This is going to be a hot topic, and if they cut twice before the election, it's going to become very political.
We'll hear from the sitting president, Joe Biden, a little bit later on this evening, 8 p.m. Eastern Time. Look out for that. I want to turn to the price action. Equity futures on the S&P 500, negative here by 0.75%. Pulling back, yields a little bit lower, down about a basis point. The 10-year 423.88. The euro just a little weaker, dollar stronger here, 108.41 on that currency pair. The data out of Europe this morning, once again, not great. PMI's really not great at all. We'll pick up on that theme a little bit later. Coming up this hour, we'll speak to Kate Moore of BlackRock following a disappointing start to big tech earnings. Stephen Trent of Citi as Delta faces fallout over flight disruptions. And Winnie Caesar of Credit Sites on the state of the U.S. consumer. We begin with our top story, Alphabet and Tesla results failing to impress investors as earnings season continues to ramp up. BlackRock's Kate Moore writing the following. Early reports suggest a potential continuation of first quarter trends. Auto, industrial, cyclicals, not yet out of the woods. Consumer spending remains tepid, and companies with positive earnings momentum into a slowing economy will be rewarded. Kate joins us for more. Kate, let's talk about the theme, and welcome to the show. It's been too long, as always.
Yeah,
let's get straight into it. Good to see you. The small caps ripping in the last couple of weeks. You don't think it's that durable. Let's start there. Why not, Kate?
Yeah. I mean, we could have like a whole conversation about this, John, but there are a few reasons. I think the most primary reason here is that small caps tend to perform when the economy is improving, when the second derivative of economic growth is positive. And we're at a point right now where I think we can all agree the economy is slowing, maybe not at a dramatic pace at this point, but in such a way that the Fed should be able to ease policy rates sooner rather than later. And that environment, that slowing economy, is not generally good for companies that are price takers, that are in lower on the supply chain, and that tend to not have the diversity of businesses that their large and mega cap peers do that cushion them through different parts of an economic cycle. I also want to point this out, because people have made the small cap argument around the debt profile. Hey, small caps have a lot of floating rate debt, and that's going to be great when the Fed starts cutting rates. Well, they need more than 25 or 50, or in many cases, 75 basis points of rate cuts before it really has a significant impact. And I want to note that a lot of the debt for the small caps comes in the form of bank loans. And we need banks to feel confident enough about the economy to be extending those loans to the small companies at the same time. So I think this is a tactical, technical, and sentiment-oriented play, and not really based on the fundamentals of small companies.
It also is based on valuations, Kate, at a time when you're still seeing some of the big tech names really garnering some pretty high elevations. You've been overweight some of the AI names, some of the big tech darlings, and even you seem to be cooling on the margins about just how much further they can go. Can you explain the sort of bifurcation of not being particularly positive on the small caps, but also sort of seeing some of the large cap beloved stocks losing some luster?
Yeah, you're right. It is a little bit of a tricky point, and I want to I hopefully want to get to a point in the fall where our view changes a little bit. But we've been trimming a little bit of our what had been a very significant tech overweight over the course of the last number of weeks, since it's really kind of late spring. And much of that has to do with the incredible performance we saw in the first half of the year. And as you point out, we've traded at premium valuations for lots of these stocks. We don't actually think most of these AI-oriented companies are going to have trouble with their earnings. Remember, they're later reporters. They report kind of late next week or in through August. I think those are going to be the real show-me moments for the theme. That said, when we're at these kind of price to perfection levels and we're at such huge premiums to other parts of the market, it's just good risk management to trim a little bit. I just also want to emphasize, though, that our enthusiasm for the AI theme has not diminished. This is more of a tactical and portfolio construction move that we've made.
Which might explain why other people seem to have a similar kind of sentiment, at least based on the price reaction to Google shares after their earnings that were largely better than expected. Just when you dial this forward, if you're marginally selling some of the large cap names and you're not buying small caps, what are you going into?
Well, we've kind of marginally sold a little bit on the AI and tech-oriented names, but we've done a little bit of sector rotation. Nothing dramatic. We're not buying into sectors we don't have a lot of conviction in. I would say we're not adding to consumer staples at this point. But, we've been selective around banks. I think there's some opportunity there. We see some very high-quality balance sheets and opportunities. We see some opportunities across energy, stuff that has gotten exceptionally cheap. And we're going to continue to kind of monitor both the growth story that could impact energy as well as the policy side. And then I would say there are parts of consumer that we do like, and we are being selective there. You mentioned just a moment before I came on that there has been very mixed news, particularly for the low-end consumer. But there are consumer companies, maybe experiential consumer companies, or those with very specific and well-loved brands that we think can be resilient even in a slowing economy. So let's just say this. We're being more selective, and we're kind of trimming on margin stuff that has run very, very hard, but not giving up on the theme.
You named a range of sectors. One I just want to tease out and build on that, and then we can go to others. Kate, energy. And you mentioned some policy considerations. Can you go a little bit deeper? How are you thinking about that sector?
Well, I mean, energy has the potential to look quite different in 2025 under one administration rather than another. And we're going to be paying very close attention to what happens in the November election, not just the presidential level, but also the congressional level, and kind of how the tone might change towards traditional energy versus renewable energy, and which parts of that complex have the best legs for the next couple of years. I will say, even though we're talking about slowing growth, we're not talking about catastrophic growth. So we think there's underlying overall demand for traditional energy, and we've continued to see that type of capital discipline that we've talked about many times in the traditional energy companies, which is leading them to look fairly profitable and to generate cash. So there's a lot to do there, and I think it's kind of an interesting and exciting sector given potential policy changes in the U.S. and elsewhere, and that may lead to some rotations within the industries in the sector.
Kate, can you just drill down into exactly what you're looking at and how the rhetoric potentially can mean an investment decision? Because under Biden, energy stocks did do well, and we're pumping at least crude natural gas, the most any country has ever produced on record, even though the former president, Donald Trump, says he's going to unleash America's liquid gold. So how do you put some of this rhetoric into a position?
Yeah, I mean, I think this is a great point. In any political cycle, there is a huge gap between narrative and reality. And when it comes to energy, you pointed this out very well, there was an enormous gap between negative rhetoric and actual reality. So here's what I will say. We have to understand what the consensus thinks. We need to understand how people, not just ourselves, are interpreting policy. And we need to position ourselves around that, not just around the real impacts of policy. It's kind of like the second derivative. It's understanding behavior, it's understanding sentiment, and it's understanding how people have gone into changes in rhetoric and the narrative in terms of their positioning. So it's a little bit of art, I would say. I mean, this is kind of one of the fun parts of investing. I think there are lots of parts of policy outside of energy, for example, that could look a little different in 2025 under either administration. We've been spending a huge amount of time, and there's a lot of the street been talking about one set of trades versus another set of trades. I have to say, I think it's premature. I've made this point multiple times, and I'm going to just underscore it again. Congress matters, and at this point, we don't have a great sense for how the down ballot votes are going to go. And if we have a sense, let's say at the end of November, for what the composition of Congress is going to look like, what kind of policies could actually be enacted, I think it's going to be an easier time to put on a more specific U.S. policy trades than today.
You've got to wait. Kate Moore of BlackRock. Kate, thank you. Appreciate it. Thank you very much. I think we noticed that from a lot of Southside research houses over the last few days, following the decision by the President of the United States to step aside, the endorsements we've seen come through for the Vice President, Kamala Harris, that many institutions didn't change their mind about who was going to win the election in November, but they did put big question marks around what would happen with Congress.
What was more interesting to me was not so much what happened yesterday with Kamala Harris in Wisconsin, was that Tammy Baldwin, the senator who's vying for her re-election for that seat, showed up. She didn't show up a few weeks ago when Joe Biden was in the state because it would hurt her. What did Alyssa Slotkin say to donors? Trump is winning in this state and it's hurting me. Now that you have a different top of ticket, does it help down ballot?
My favorite part of her conversation was the psychology of just sort of understanding how people understand policy, the sort of second derivative aspect of it, and sort of gaming out what they think might be the case.
What you think is not important.
Not at all. And I love that, because to me, trying to get a handle on what other people are thinking right now is just as challenging as trying to get a hand on policy that's somewhat elusive.
That's the art of the next 4 months that's going to drive everybody nuts. Equity futures on the S&P pulling back by 0.75% with an update on stories elsewhere. Let's get your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. AT&T saw a second quarter subscriber increase thanks to ongoing promotions and a lower churn rate. Shares, you can see there, higher by more than 2.6% in the pre-market. AT&T had its first year-over-year increase in new monthly phone subscribers. The number of cancellations fell, likely in response to a marketing push that gives new and existing customers the same deal on new phones and plans. Southwest Airlines is facing enhanced scrutiny from U.S. regulators over a series of recent flight safety incidents. The FAA has launched an audit to review events, which include a flight that came within 400 feet of plunging into the ocean off Hawaii, and a plan that took off from a closed airport runway in Portland, Maine. The carrier said it has already formed a team, including airline leaders, pilot union members, and the FAA to identify opportunities for improvement in its safety management system. Aston Martin shares are higher in the London trade by more than 8%. The British car maker saw strong demand for its pricier limited edition supercars. Aston Martin delivered 118 of its special models in the first half of the year. That compares to 38 last year. It was led by Valkyrie and Valor models, which cost at least $3 million and $1 million, respectively. That helped boost the average selling price, offsetting what was otherwise a drop in deliveries. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Just got a message. Neil Dutzer, Renmac. Nice to see Dudley coming around. That just dropped in the inbox just now. You know, I think a lot of people come into this view that maybe, you know, July should be a real consideration, which has been Neil's view for a number of weeks now.
Which, again, is the reason why people are looking at some peripheral data, like the housing data yesterday, and putting more emphasis on it, because it confirms the current narrative of a more protracted weakening.
Up next on the program, Netanyahu making his case on Capitol Hill.
I would like to hear him talk about what he plans to do to end this war. I would like to hear him say that he's going to initiate elections in Israel so that the Israeli people who have been demonstrating against his leadership understand that there's the potential for an option.
That conversation coming up next, live from New York City this morning. Good morning.
40s.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Equities negative here by 0.75% on the S&P. Yields just a little bit lower, down a basis point. The 10-year 423.69. Under surveillance this morning, Netanyahu making his case on Capitol Hill.
I would like to hear him talk about what he plans to do to end this war. I would like to hear him say that they're going to increase humanitarian aid to all of those Palestinians affected in Gaza. I would like to hear him say that he's going to initiate elections in Israel so that the Israeli people who have been demonstrating against his leadership understand that there's the potential for an option.
It's the latest this morning. Israeli Prime Minister Benjamin Netanyahu speaking before Congress at 2 p.m. Eastern today, where he's expected to try to shore up support as the war in Gaza continues. Netanyahu set to meet with President Biden and Vice President Kamala Harris separately on Thursday, followed by a meeting with Donald Trump on Friday. Aaron David Miller of the Carnegie Endowment for International Peace joins us now for more. And I want to get to this question. President Biden is a lame duck president. We all understand that. Do you think that gives him less space to deal with the likes of Netanyahu, or more space to find an agreement?
I mean, look, I think from the beginning of this conflict, thanks for having me, John, the tone, the trajectory, the motives, the calculations, escalation, de-escalation have been set by the two major combatants, Israel and Hamas. If there is a deal, and I suspect there's a reasonable chance by mid-August that you actually could achieve one, I think it'll have more to do, frankly, with changing calculations on the part of Hamas and or Israel, particularly Mr. Netanyahu, than it will be with American pressure on one hand or American persuasion on the other.
Aaron, we have commercial ships in the Red Sea still under threat. We have 5 Americans still under hostage from Hamas. What kind of deterrence do you see from this administration currently?
You know, I think, and there are many feelings about the administration's policies toward this war, but I think the one issue that they've been relatively successful on is preventing what I would describe to you as a major escalation. Certainly, the Houthis are going to remain a problem. I mean, they are a keeper. There's no question about it. They are, according to some analysts, the southern Hezbollah, and they've demonstrated that they have reached. They launched this Samad drone 1,300 miles from Yemen into downtown central Tel Aviv. Not even Hezbollah has done that. So I think the administration has to deal with a certain number of realities, and one of those is that Iran has benefited greatly from the use and exploitation of their proxies. And there's very little, frankly, pending some transformative agreement between the U.S. and Iran, highly unlikely, certainly between now and the end of this administration, or probably for the next. So that's a problem that the United States has no solution to, and it's going to have to try to manage to the best of its ability.
It feels like we continuously see red lines crossed when it comes to this conflict, but especially when it comes to Iran. What is the policy currently from the Biden administration?
Management and de-escalation. And look, in fairness to the administration, frankly, any administration, I work for a Republican and Democratic administration, we have a strategic problem with Iran, both on the nuclear side and with respect to their use of proxies in the region. And we have no strategic solution. The reality is you have a regime that is highly ideological and dangerously pragmatic. It's expanded its reach now in creating a virtual alliance with Putin and his war against Ukraine. It's backed Hezbollah, the Houthis, Hamas in Gaza, at little cost and expense to itself. The Iranian problem, unless there's a change in regime, in my judgment, is going to be a management problem. It's not pretty, it's not emotionally satisfying, but frankly, it's a cruel reality. I just don't see the alternative right now.
So given that that's sort of an ongoing simmering issue, looking inward, you've worked with both Republican and Democratic administrations when trying to manage this situation and the implications for Israel. Have you ever seen such a big divergence between Republicans and Democrats in terms of support for Israel?
I mean, I think you really broke the code. You have a degree of polarization and the fracturing of bipartisanship that is unprecedented in this relationship. The Republican Party, and again, I voted for Republicans and I've worked for Republicans, maybe not these kinds of Republicans, but the Republican Party has emerged as the Israel can do no wrong party. And the Democratic Party is split, not just between progressives and mainstreamers. You have mainstream Democrats, Chris Coons, Chris Van Hollen, Chris Murphy, who at one point or another over the last several months have publicly called for conditioning military assistance to Israel. So what is at stake here? I think literally, for the first time in the history of the U.S.-Israel relationship, is a debate between Republicans and Democrats and within the Democratic Party about what it actually means to be pro-Israel. And that, for anyone who is interested or cares about a strong, healthy U.S.-Israel relationship based on reciprocity and trust, that is a very worrisome development.
So what is a pro-Israel point of view from the Donald Trump camp versus the Kamala Harris camp?
Well, I think all presidents are blind dates, right? So no matter what their resumes are, when they get to the White House, they essentially are going to be tested. You've had 4 years of a trial run with Donald Trump. And again, I'll say it again, I voted for Republicans and Democrats. I've worked for Republicans and Democrats. I think it's fair to say that Donald Trump, whose conception of the national interest, frankly, is transcended by his own personal interests, excuse me, and tethering to his political interests, created what I would call, as a believer in a strong U.S.-Israel relationship, a sort of a sugar high for Israel. A series of goodies, pro-Israeli gestures, and policies which were very pro-Israel and appreciated certainly by Benjamin Netanyahu, with whom the former president has a sort of Vulcan mind meld. But on balance, the Trump administration, even though it deserves credit for the Abraham Accords, also had no serious significant policy or approach to managing what I think is probably the greater challenge that the Israelis face, and that is what to do about the Palestinians. You have 15 million humans, and let me deploy river to the sea here in an educational context. You have 15 million humans living between the Mediterranean Sea and the Jordan River. What are you going to do? How are they going to coexist? In my judgment, the only rational, even though it's more attuned to a galaxy far, far away than back here on planet Earth, is separation through negotiations. And the Trump administration took an approach on the Palestinian issue, which essentially discounted it as a factor. And I think we see year after year after year that this problem, the Hamas terror surge, brutal Hamas terror surge, is not a manifestation, in my judgment, of what the more rational elements within the Palestinian community want and believe they can actually achieve for their people. So focusing on Palestinians, I think, is critically important, however grim the future of a two-state solution is right now.
Aaron, we've run out of time. That was deeply thoughtful. The subject has always been polarizing. It is even more so in 2024. Aaron David Miller of the Carnegie Endowment for International Peace. Interesting where Kamala Harris won't be a little bit later on today.
She will not be at the address by Netanyahu. Instead, she's going to go to a pre-scheduled event addressing a sorority in Indianapolis. And I have to say, from the foreign policy, national security world, this is getting a lot of pushback.
Live from New York City. Coming up next, Stephen Trent of Citi will pick up on the fallout of Delta's cancellations.
What's happening on Wall Street?
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
If you are just joining us, welcome to the program. We are about 2 hours away from the opening bell. Just the flavour of the price action for you, starting with the S&P, pulling back by 0.6%. On the Nasdaq 100, down about 1 full percentage point. We know what's responsible for that. If you add up the weightings of, say, Alphabet together with Tesla, you're talking about 8% of the Nasdaq 100, and both of those names are down in the pre-market. We'll pick up on those earnings in just a moment. I want to turn to the bond market, sit on the 10-year. Yields at the moment on a 10-year down by about a basis point or two, 423.49. The headline this morning, not from the earnings, not from the data, from a former Fed official. I think we have to sit on this quote from a former Fed official, and that former Fed official is the former New York Fed President, Bill Dudley, saying he's changed his mind. The facts have changed, his view has changed. Although it might be too late to fend off a recession by cutting interest rates, dawdling now unnecessarily increases the risk. He thinks they should make a move. And Lisa, we've been talking about this for a number of years. Bill Dudley is no Uber dove. He was very, very hawkish and thought this Fed should get a move on a long time ago, and he was talking about 5, when I have to say hardly anyone was talking about 5% interest rates. And up until recently, he was saying there's a risk of inflation staying sticky, maybe even re-accelerating. This is a big change, and when you go through the body of this piece on Bloomberg Opinion, this opinion is built on his view of what's developing in the labour market. And that's front and centre for a lot of economists at the moment.
Which is the reason why, and we talked about this earlier, jobless claims are going to be really important. Initial jobless, ongoing claims. The idea that that's risen to the highest level since 2021. How quickly this is deteriorating. That's why the Redfin data was so interesting that you pointed to. Deals are collapsing at a record pace in the housing market because people are assessing their monthly costs and wondering what they can actually afford. There is this feeling that things are deteriorating at a faster clip, maybe not falling off a cliff, but maybe signaling a bit of a change in the economic cycle.
Feels like things are starting to pause, just across different issues, housing being one. I'm thinking of another, let's say, Tesla, Elon Musk saying, I'm not going to make that investment in Mexico until I know the outcome of November. That note from Goldman that we started the program with on China, I think, is notable as well. Basically suggesting over at Goldman Sachs that China is holding back on fiscal stimulus to wait and see if they get a Trump shock in 2025 that they need to respond to. Just a lot of pauses that you're seeing across the board here.
And a lot of pauses from just consumers making certain purchases. And again, you talk about how difficult it is to read this earnings season. GM comes out with better than expected earnings because they're selling trucks. And yet dealer data shows that they're actually providing the greatest numbers of incentives for cars more broadly to move them off the lot. You're seeing in the EV space a real weakening. So right now, you can't really get a clear read, but the pockets of weakness are being shown in in many more corners.
And what happens in the United States, what does that mean? How does that reverberate around the world? Bernard Arnault today, also in his statement, talking about this uncertainty when it comes to economic and geopolitics. I feel like the C-suite has finally this week basically woken up to the concerns and the political uncertainty ahead of November 5th, which basically says to me, these decisions are not going to be made until they have a clear-cut view on not just the White House, but the composition of Congress as well.
Without a doubt, it's about the policy in 2025. And for a number of months, we've had a key phrase on this program, flying blind into 2025. Let's finish on foreign exchange. Another day of Japanese yen strength for you. Dollar yen pulling back for a third consecutive session. We're down to about 154, 154.45, and negative 0.75%. 3-day streak of yen strength. Haven't had one since early May. That's how bad the Japanese yen story has been through 2024. That's foreign exchange under surveillance this morning. Our top story, President Biden addressing the nation tonight at 8 p.m. Eastern from the Oval Office. It will be his first on-camera address since he ended his re-election bid on Sunday. Biden has been isolating at his Delaware beach home since last week when he tested positive for COVID-19. He's had a few days. I understand they've been writing this speech for a while. What are you expecting to hear?
Well, we need to see the President of the United States. He has told us on 3 different occasions he was staying in the race unless 3 things. The Lord Almighty came down, data, if we saw in the polls, someone said you couldn't win, or if there was a serious health concern. Then all of a sudden, he releases a letter on Twitter without addressing the U.S. He's a sitting president. He's not seeking re-election. This does not normally happen, and we should be seeing the President of the United States. So I just want to hear why he has changed his mind. Was it the political pressure? Does he feel like he cannot serve out his term, serve out another 4 years? But does that mean that he feels up to the job until the remainder of the year?
People are just going to be looking at the tone. They just want to see that he's actually really going to come out with a strong message of support for Kamala Harris, but also does seem cogent to that point. The idea of just being a presence that can remain in office for the remainder of this year.
There's so much criticism coming from the right. And we've all heard the question being asked a million times. It was being asked up until Sunday. It's being asked after Sunday as well. If you can't campaign, if you can't run, can you govern? So really, it's the right. They're going to put even more pressure on. If we have a shaky address again this evening, you'll hear more calls for that. Look, he's had a 50-year career in politics. He deserves a graceful exit. And let's hope he gets one over the next few months. The policy issue here for the next 6 months is what really interests me. I wonder how much space he has just to follow his political instinct around issues like Israel now, given the fact that he doesn't have to worry about campaigning, he doesn't have to worry about November, he doesn't have to worry about the progressives anymore. He can just follow his political instinct in a way that he might like to.
Potentially he'll lean a little bit more into Israel, because you can already see this week 2 separate meetings Netanyahu's having, one with the President of the United States, currently Joe Biden, and one with the presumptive nominee, Kamala Harris, who in March was the first one to really come out and call for this ceasefire. Then reporting since then has been that she has told the president he should take a little bit more of a heavy hand when it comes to Bibi.
His hands are a little bit tied because Kamala Harris is viewed as the continuation candidate. So if he goes really rogue or really materially shifts policy, that could end up weighing on her campaign as well.
That's the latest on the politics. I mentioned the earnings. Alphabet, Tesla, shares are falling in the pre-market after their results failed to impress investors. Numbers from Tesla weren't great, down by more than 8% in early trading. We had Ben Callow of Baird on the program a little bit earlier. He's got faith in the story going forward. New product line, robo-taxi, new automobiles. He says you should buy this dip. Alphabet's a confusing one. If you go through the numbers from Google, they really weren't that bad, with the exception of maybe weak performance from YouTube. And getting punished for higher CapEx spending was interesting too. Mandeep Singh of Bloomberg Intelligence was with us earlier this morning, and he made the point that if Meta comes out with a similar story, they'll get punished next week as well.
This is buy the rumor, sell the news. Essentially, this is a stock that's up 30% year to date. People saw the earnings. They were not bad. They were good, but they weren't out of this world. They didn't promise some sort of new increased revenue in some sort of dramatic way. And putting that together with what Kate Moore was talking about, the gains are so good that some people are just taking chips off the table or whatever cliche you want to say in order to just pause. It goes back to this pausing, this feeling that maybe we need to reassess at a time of transition.
How many things go on pause over the next few months? My favorite line from Mandeep a little bit earlier on, that if the CrowdStrike issues hadn't happened, cybersecurity firm Wiz would have made that deal with Alphabet, and that it fell apart because they think they can do better on their own based on that it's a big opening now.
And he said they probably could if they go public in the next 3 months. So let's see if they go public in the next 3 months.
We need to talk about that tech outage on Friday, and one company in particular that's still struggling with it. The US Department of Transportation opening an investigation into Delta as flight cancellations continue after Friday's global technology disruption. Transportation Secretary Pete Buttigieg saying 3,000 passengers have filed complaints with the department. Lisa did like 1,000 of them. Stephen Trent of Citi joins us now For more. You're surprised there weren't more than that. I think other people are too. Stephen, let's get into this. Typically, when you see outages like this, there is this favorite word of economists that we often hear by analysts as well, transitory. It sort of comes and goes, we move on, it doesn't leave a scar on the stock. Stephen, do you think this moment is different for this airline, which, excuse the pun, has been flying high for quite a while now in this country?
No, thank you very much for having me, and good morning. So when we see outages like this, this is a little worse than what would typically see from a network outage or from some kind of weather event. So people think, for example, back to Southwest in December 2022, you saw that carrier's cancellations around the low 70s for a day or two, which is considerably higher than what we're seeing for Delta today. So Delta, we saw a couple of days where the cancellation rates were in the 30s, but indeed it's a couple of days. So Delta did have a technology outage in 2016, and that resulted in, for example, 2,300 canceled flights. At this point, unfortunately, the carrier is above 5,500 cancellations since Friday. So in terms of scale, it is a little bit tougher than most of what we've seen in the past.
Stephen, you know these companies inside out. What is it about how Delta operates that has meant they found it much more difficult to respond and actually make sure they can come out the other side of this faster than the other airlines have? It feels like it's back to business at American, at United. Why can't the same be said about Delta when they all experienced a similar shock?
Yeah, absolutely. So not every airline has the same technological setup. It's conceivable, for example, that the other carriers do not have as much exposure to CrowdStrike, and maybe some of the carriers don't have any exposure. You know, over the last couple of weeks, for example, to its credit, we saw very little disruption with Southwest or Alaska Airlines, for instance, where Delta, for instance, has something like over 10,000 individual systems that it has to restart as a result of this CrowdStrike outage. So the relative exposures are not the same.
I guess there's a larger question here, Stephen, and we've been asking it in terms of how do you diversify away from being so dependent on one system that you could be vulnerable to this type of thing happening? Has anyone been examining the vulnerabilities, not just in Delta, but other airlines as well, in terms of, you know, United was really sunk when there were problems with specific Boeing planes. There is this question now with Delta and CrowdStrike. Are there sort of key vulnerabilities that people are studying within the airlines that could sink entire systems all of a sudden in a flash?
Yeah, it's a hard one because I think the group thinks about these kind of risks all the time. So, for example, today, exactly as you said, if you're an airline that's operating only Boeing 737 MAXs, you have a different set of supply risk, for example, versus a competitor that has Boeing, Airbus, and Embraer planes, for instance. So that's always a risk. In terms of whether these airlines need to have different systems set up, you know, that's something that I think the group is probably going to be looking into. At least elements of the market are going to look into that. You know, on the other hand, there are other risks with having too many suppliers. Just look at global supply chain today. You basically need everything to go right. And I know it's not exactly the same situation, but you need everything to go right. And 2 or 3 suppliers can really, you know, screw up the works, so to speak. So I think in this case, certainly, I would imagine that elements of the group are going to be looking at how to have some fail-safes in their technological supply going forward.
I was struck by the Delta union saying pilots felt, quote, abandoned basically by the system and the company. How does Delta then close basically the trust gap they're going to have with their flyers, but also their staff?
Yeah, so I think you have a situation like this with thousands of flights canceled. You know, very easy to say that for anybody involved, it's a very emotional situation. And I don't want to dismiss what frustration you may have from pilots or customers or flight attendants. Certainly they have very real frustrations, and many of them have had really bad weeks. I get that. I think when the dust settles on the root causes of this and how it might be mitigated going forward, I wouldn't say it's fair to take, the worst point of consumer and employee anger and project that forward. This problem did not start with Delta. Delta is not the origin of this technological problem. They are collateral damage, as were hospitals and 911 call centers in various places. So I think the actions that the carrier takes going forward present an opportunity in terms of its relationship with those constituents.
Stephen, great to get your thoughts, sir. Appreciate it. Stephen Trent there of Citi on Delta Airlines with a buy rating on the stock. And I can tell you, the analyst community, incredibly bullish on Delta. 21 buys, 1 hold, and not a single sell on that company, even with all these pictures of people stuck in airports.
Ultimately, and I'm not speaking personally, but theoretically, if someone were to get caught in an airport with a particular airline, you might have some sort of, PTSD, but you actually go fly another airline if you have certain loyalty and you have certain, perks, et cetera, et cetera.
Sure, yeah.
It becomes challenging, and that is what they're facing with.
Do you want to talk about something?
No.
Stuck in Atlanta and still flying with them?
It was horrible.
I feel like I'm the only one that flew Delta over the weekend. It only had a 2-3 hour delay, and it was fine.
I told you on Monday morning, you were one of the lucky ones, without a doubt about it. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's get to Danny Berger. Hey, Danny.
Hey, John. Shares of Visa are down in the pre-market 3.4%. It reported its first miss on quarterly revenue since 2019. It had $8.9 billion in revenue for the fiscal third quarter. That is just barely shy of the average estimate. But credit card spending worldwide has been holding up. It climbed 4.9% from a year earlier. In the U.S., where Visa gets about 40% of its revenue, spending advanced 5.1%. But Morgan Stanley analysts said that investors were instead focused on the slowing travel spend in July. And some good news for the beleaguered plane maker Boeing. The company resumed deliveries of its 737 MAX aircraft to airlines in China. The announcement comes after a roughly 2-month pause imposed by aviation regulators in China to review information about batteries used in cockpit voice recorders in Boeing's planes. Boeing, though, is still grappling with leadership upheaval after being forced by U.S. transport regulators to slow production over concerns around its manufacturing safety standards tied to the Alaska Air 737 MAX door blowout. And the Blackstone Mortgage Trust is cutting its dividend by 24% as defaults pick up and borrowers struggle to make payments or refinance their loans. The $3.4 billion REIT provides loans to commercial real estate groups, and most of the troubled loans are on U.S. office buildings, which make up about a quarter of its loans outstanding. It also authorized a share buyback of up to $150 million, yet the stock is still down nearly 7% in the pre-market trade. In a statement, the REIT CEO said that they were still well positioned with, quote, strong liquidity, accelerating repayments, and an emerging investment pipeline. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, cracks in the consumer.
Consumer spending has been much weaker. It's grown in the first half of this year, but at a much slower pace than it grew in the second half of last year. And that's a really material change in the environment.
We'll talk about those cracks up next on the show. You're watching Bloomberg Surveillance.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
The opening bell, 1 hour and about 42 minutes away. Going into that opening bell this Wednesday morning, and good morning to you all. We're down about 0.75% on the S&P. Bit of a rally in the bond market. Yields are lower by 2 basis points. The 10-year 422. Let's call it 423. Under surveillance this morning, cracks in the consumer.
I can understand why the Fed has been so cautious after the whole transitory fiasco, but I think I'm getting close to the point where I think they're too late now. The lagged effect of the Fed's actions are beginning to kick in. Consumer spending has been much weaker. It's grown in the first half of this year, but at a much slower pace than it grew in the second half of last year. And that's a really material change in the environment.
So here's the latest. Investors looking for insight into the state of the economy with GDP and initial jobless claims due tomorrow morning. The former New York president of the Federal Reserve, Bill Dudley, writing this: the facts have changed, so I've changed my mind. The Fed should cut preferably at the next week policy meeting, although it might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk. Winnie Caesar of Credit Sites joins us now for more. Winnie, this line from Ian Shepherdson, I think it's getting to the point where they're too late right now. Winnie, what do you make of that and what we've heard from Bill Dudley already this morning?
Well, I think that the change in tone that we are seeing kind of across the market is quite notable. We went from pricing in 200 basis points of rate cuts at the end of last year to no rate cuts earlier this year as economic data came in stronger than anticipated, and now we're seeing a shift again. So I think that the big takeaway is people are having a really hard time tracking where exactly this economy is going to go. Now, we do agree with Bill Dudley that we should probably start to see rate cuts sooner rather than later. We have a September rate cut penciled in and rate cuts continuing thereafter at every meeting at a 25 basis point clip. And that's very much predicated on the consumer slowing that has already started to materialize and probably will continue at least through the second half of this year.
Lisa told me a long time ago that when the economy gets bad, credit spreads get wide. I don't believe her anymore, Winnie, because I don't see it. 300 basis points, high yield spread, super, super tight. We're less than 300 now. Does credit give you that cyclical signal that it used to give you all those years again, or has something changed?
Well, the big change that we're seeing right now is that the yield environment is still very different for a lot of investors in the post-GFC era. We still have high yields closing in on 8%, investment grade north of 5%. And as we balance the spread proposition to the yield proposition, people kind of look at credit yields and think, oh, this is okay. But the reality is spreads are very tight. And with July being a seasonally very strong month historically, we have been recommending that clients start to go a bit up in quality, sell into some of this strength, and really put cash to work in the things that have gotten cheaper, relatively speaking, in the higher rated parts of the market.
That said, Winnie, usually is a correlation between small caps and credit spreads. And what you're seeing right now is actually a rally in small caps at the same time that we're seeing a shift in tone. I mean, it all is a bit circular and head spinning. Is this really just a valuation play at a time when people see the softening is not necessarily being a wholesale recession?
Yeah, it's really interesting because within the world of corporate credit, there have been a handful of sectors and issuers that investors have basically said, nope, we're not willing to extend these capital structures. We think that they're over leveraged. We think that there's some sort of secular decline within the business or within the sector more broadly. Whereas we're seeing that, rotation into small cap equities. And so it is a little bit of a head scratcher, those two different dynamics. And, generally, I do think that credit markets tend to get things pretty right. They are kind of the driver of where liquidity goes within the system. So I'm really paying close attention to the reality that CCC spreads are still wider on the year, despite this recent rally in small cap equities.
There's also this larger question of how quickly things are deteriorating. There was this feeling from Bill Dudley's column that it's actually faster than he thought it would be. We heard the same kind of tone from Ian Shepherdson. It is too late at this point, potentially, to get ahead of a recession. Is there anything in the granular data from companies, from different earnings calls that you're hearing that suggests that things are truly rapidly deteriorating in real time?
So this is a really interesting question, and I rely very much on my analyst team at CreditSights to help me navigate some of these nuances. And I would say my consumer team in particular has been highlighting probably for the past 3 to 6 months that consumer behavior is shifting quite notably. They see that in management commentary, they see that in earnings results, reflecting a downtrade in terms of store brands versus regular brands, a deceleration in restaurant traffic and restaurant spending, different types of spending versus services versus goods. And so we are very focused on some of those more granular data pieces that our consumer team has been seeing and highlighting for the past 3 to 6 months or so.
Winnie, awesome to get your perspective and your view over at CreditSights. Winnie Seater there of CreditSights, looking for that consumer-led slowdown. Citi also looking for the same thing. They're looking at housing. Citi and Andrew Honhorst saying the housing sector is often a leading indicator of broader economic strength and suggests softer growth is coming in the coming quarters. The housing data not tremendous in the last 24 hours.
Yeah, we got some negative data yesterday, not only the Redfin data that you were talking about, but just in terms of some of the home sales coming in much lower than expecting. Existing home sales coming in, falling to 3.89 million versus 3.98 million expected, falling to some of the lowest levels in many months. This is the question. Are we seeing a real-time deterioration that doesn't happen in a linear way? And that is really the concern. I mean, the Redfin data, I want to sit on that for a hot second because it indicates that people are taking a look at their expenses after making a deal and saying, this is not going to work, and they're doing it in mass. There is something significant in that.
I'm really looking forward to Chairman Powell this time next week and his characterization of the labor market. It was only a number of weeks ago that Chairman Powell was addressing the country, financial markets, economists, and basically saying the economy is okay, the labor market is still strong, and because of the labor market strength, we have time. And now you're getting warning after warning about just how much time we have and just how strong this economy and this labor market actually is.
Two things. He can either signal that definitely they're going to go in September and set that up. If he goes this week, or next week rather, there will be concerns about what the political sort of understanding of that could be, especially because of some of the recent political turmoil.
This is the difference between being a sitting Fed official and a former one.
Correct.
If a sitting Fed official used some of the language that Bill Dudley's used in this Bloomberg opinion column this morning, I think it would spook this market big time. Like, get a move on, you might already be too late. Like, that is some spooky stuff if that came from the Federal Reserve directly. The third hour of Bloomberg Surveillance, up next.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The process of diversification is necessary, but you need exposure to these magnificent seven.
We want to be a little bit more defensive. It doesn't mean equities can't do well. It's the larger cap. It's the higher quality. It's because growth's slower.
In the small business sector in particular, the squeeze is quite intense.
In pockets of small caps, there's still a lot of opportunity.
Inflation's moderating, so it's an ideal scenario for the stock market.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now. 90 minutes away from the opening bell with tons of stuff to get through. Lots of news flow. Let's start with equity futures on the S&P 500, pulling back on the S&P by something like 0.75%. A much bigger move on the Nasdaq 100, down by 1 full percentage point, with Tesla dropping in the pre-market by a little more than 8%. Another disappointment for the EV maker led by Elon Musk.
This is a fourth straight miss versus expectations for Tesla at a time when this is becoming an increasing hope trade more than reality in terms of justifying valuations. I say hope with respect to the robotaxi and getting that up to speed. A real question here is how much longer can he hinge on that hope versus just actually delivering over the longer term?
This gets big tech of the earnings season for mega cap tech really going. Over the next week, it picks up even more. You'll hear from the big players, the likes of Apple, Amazon, Microsoft, Meta, all next week. But there is some momentum building here. A lot of people starting to come on the program and talk about the need to cut interest rates and cut interest rates like right now. We heard that from Neil Dutter of Renmac. Others have followed. Earlier on this morning in Bloomberg Opinion, Bill Dudley, the former New York Fed president, making the same point. I've changed my mind. The Fed needs to cut rates at this meeting in July. Look, I think most people on Wall Street don't expect that to happen. Will it be a live meeting? I've got no idea. Based on the communication from Fed officials over the last few weeks, they've been pretty consistent. We're getting closer. We're not there yet. What's behind some of these worries is important. So let's tease it out. It's concerns around the labor market, and that makes jobless claims on Thursday even more important.
Especially because we have seen an increase that has been fairly steady, albeit from a very low rate. Here's the issue. Are things truly deteriorating that quickly, or are people just reassessing the data that already is out there? The earnings are not providing a clear picture on that. The rhetoric isn't necessarily clear. And the market's action also very confusing. There is no reason, if people are truly worried about a truly weakening consumer, that you see small caps outperforming and credit doing wonderfully. So it's a real sort of contradiction.
This is why the labor market's going to be in focus. Jay Powell said to the Senate Banking Committee, the labor market appears to be fully back in balance. At the same time, what we hear and what Dudley is talking about is the fact that consumers there's this bifurcation. And what we're seeing, even LVMH, is the higher end potentially is not spending as much. It was the lower end for a while. Walmart trading down. Winnie just talked about that. She's seeing more consumers trading down. Is that going to happen now across the socioeconomic spectrum?
That deceleration in LVMH revenue growth is notable, that's for sure. We're looking at 1% for the fashion and leather goods revenue in that division, 1% growth. Go back 12 months, you're looking at double-digit growth. And now we're talking about double-digit declines in the region that includes China. That name is down by about 4.5%. It's been a terrible time for luxury players over in Europe over the last few weeks. We've talked for a long time about easy financial conditions, tight credit spreads, equity still near all-time highs. That's still the story. Credit spreads are incredibly tight. The equity market's not a million miles away from a record high. But Andrew Hollenhorst of Citi published this just moments ago. And Andrew Hollenhorst of Citi has been making this argument for a while. You're going to get the slowdown in the economy, and when the Fed starts to cut interest rates, they'll cut rates more than you think they will. This is what he has to say. The commencement of Fed rate cuts was supposed to be a risk-on moment for markets. Instead, it's got a different view. Equities are selling off just as the Fed prepares to lower interest rates. The sell-off, if continued, Lisa, could provide another impetus for more dovish Fed policy. It's quite a big call.
It's also quite a few steps from where we are. It's not as though the market is falling out of bed yet. And the areas that are falling are the areas that did the best so far this year. That said, it sort of shows the asymmetry in the market response function that the Fed has. Markets go to record highs. That's not a reason not to potentially cut rates. But if they start falling, that is a reason to cut rates. Do they really go back to that kind of asymmetric relationship?
There's some real asymmetry there. Let's get into the equity market. Let's start here. Counting it down to the opening bell, equity futures right now down by about 0.75% on the S&P. In the bond market, yields are lower by a couple of basis points. The 10-year 422.91. In foreign exchange, the euro, a little bit of a snooze. I think dollar yen wakes you up just a little bit more, Lisa. 3 days of yen strength. Haven't seen that since early May.
Coming off some of the weakest levels that we've seen in many decades, a question of how much this is a Japan issue heading into the Bank of Japan next week versus a U.S. dollar issue as people look to an almost sure thing of a Fed rate cut in September.
That's some divergence, isn't it? If we get a hike from them and a cut on the other side, we'll see. Here's the lineup this hour. Sebastian Page at T. Rowe Price as the start of Mag 7 earnings fails to impress. Bloomberg's David Welch has tested reports a fourth straight quarter of profit losses. And Michael Kushner of Morgan Stanley on why soft landing prospects remain on shaky ground. We begin with the big issue, disappointing tech earnings weighing on stocks this morning. The results coming just as investors start to rotate out of tech and into small caps. Sebastian Page at T. Rowe Price expecting markets to broaden out, saying this: we're not in an internet bubble, but in 2001, when the tech trade unwound, value outperformed growth by 45% in 12 months. Stickier than expected rates and inflation could favor value. Seb joins us now for more. Seb, it's good to see you. Good morning.
Great to see you.
Kate Moore of BlackRock on the show earlier on. She said she had doubts about how durable this rotation might be. You don't seem to have those doubts. Share them with us.
More confident on the value side of the rotation than on the SMID side. And within small, we like mid better than small caps. So look, it's not a pound the table call. We are overweight value. You saw my quote about the tech bubble. This is not the tech bubble. And here's an interesting thing you can do. Adjust price earnings ratios historically for return on equity. And what you'll find is that we're in an environment where those mega cap techs have unbelievable return on equity, unbelievable fundamentals relative to the tech bubble. But nonetheless, trees don't grow to the sky. These things can revert really quickly. Even in 22, you had value outperformed by 20%. So if you take a 12-month horizon, you look at the election and some of the possible catalysts, we're long value.
Mandeep Singh of Bloomberg Intelligence was making the point that some of these mega cap tech names might actually get punished for increased capex, even if it is around AI, even if there is this huge amount of enthusiasm for that particular theme. What do you make of that call? Could we see these companies be punished for the investment decisions they're making if the revenue story doesn't follow quickly?
Look, these companies are doing really, really, really well. The problem is the way markets work, the expectations are just really high. I've said this before on your show, Jonathan, the secret to happiness in life is low expectations. That's a problem for mega cap technology companies. So yes, they could disappoint because the expectations are just huge. There are 4 stocks right now in this earnings season that are expected to grow earnings by 56%. And I think the market is extrapolating this kind of earnings growth a little too much. If you look at projections towards the end of the year, value stocks year-over-year earnings growth is expected to outpace year-over-year earnings growth for growth stocks. Just wrap your head around that. I don't think the market is pricing that right now.
So the rotation is selective within the big index, not necessarily beyond that. As you look to stocks that haven't necessarily been bid up as much as others, how much are you still aggressively neutral?
Yeah, we actually have a 0.5% overweight stocks, but it's not worth talking about. Look, we are confidently neutral, and this means
is that a downgrade?
Aggressively, confidently, with lots of conviction, neutral. And you know, the reason why I emphasize that is you have a risk tolerance that you work on, say as an individual investor with an advisor. There's a lot of work that goes into that. That's what I'm arguing for. I'm not arguing for being in or out of the markets. As an investor, what is your long-term risk tolerance? And this is kind of where you want to be right now. The bears on our asset allocation committee are talking about decelerating economy into very high valuations. That's compelling.
Sure.
But we have raging debates because what are the bulls saying? They're saying earnings are coming up and rates are coming down. So these are tough debates to have as investors. Figure out your risk tolerance. It doesn't have to be 60-40. If you're far away from retirement, it should be more stocks, but stick to that.
Is it basically 60-40, the bears and the bulls on your investment committee, where basically the 60% sit on one side, the 40% sit on the other? Has there been a shift where more people are starting to see the deceleration and getting more cautious, or is it still aggressively balanced in those debates?
Look, it's fairly balanced, and to let you in something that happens in asset allocation committees a lot, the bond managers tend to be more cautious.
Oh, you don't say.
The stock managers tend to be more optimistic. But when you have these discussions, you kind of know where people stand with their biases, and then you adjust for it. But this is a market environment. I got to say, we've never had this intensity of debates between bulls and bears.
You've got a paper coming out later this year on leadership. You can share some of the details of that with us now if you want to. Just give us some insight into how you help the committee come to an agreement when there is that kind of division between the bulls and bears around a table.
Well, here's the key thing about the committee, which has been over several years a huge improvement to our decision-making process. And the research shows this helps, bring an independent view to the table. So we have a pre-meeting survey where every member will disclose what they want to do in terms of tactical asset allocation shift, not knowing what the other members are suggesting. So we have independent expertise brought to the table, and then we debate it. That's an improvement to decision-making processes. On the psychology of our business, I've become quite passionate about this. John, there's a huge link to sports psychology, because sometimes you win, sometimes you lose. You control your process, but you don't always control the outcome. Doesn't that sound like sports?
Sure.
And how do you build resilience to setbacks in markets? So there's a huge unexplored, I think, research body or body of research that can apply to money management that we haven't. So I'm putting out this article, Journal of Portfolio Management, later this year.
The psychology of paralysis right now is something that I'd love you to comment on. There have been a number of people, guests on the show this morning and in the past week, who seem rather mired in this period of uncertainty ahead of an election, potential policy shifts, and frankly, such big dissonance between the bulls and the bears. How do you get away from that paralysis?
So, staying on the side of psychology, there's something called core beliefs, which is how people look at the world, their biases to interpret events and make decisions. Well, investors have core beliefs. And if your core belief is that you should stay invested for the long run, then maybe call it paralysis, but maybe call it just good investment discipline. So I don't, equate paralysis. I think you need to stay invested, stay diversified. This is very trite. But you step back and you ask, what are your investment core beliefs? Are you a follow the trend investor, or are you a valuation-focused investor?
Well, let me pick out one, and I think this might be an interesting thing to explore. We're getting deep in the weeds here and away from the news flow, but we've got a few more minutes. I think if you are raised and you have a career exclusively in the United States of America, your core belief is to stay invested. I think if you have experience outside of America, you have experience knowing that that doesn't always work, and there are such things as lost decades. And I think a question I would have for you as an asset allocator who has a core belief, I know, to stay invested, when people offer that example to you of what has happened elsewhere, in stock markets in Europe, Japan, and elsewhere too, what do you say back to that? Do you just maintain this core belief that America's different and it will always be the case that you just stay invested and you'll be rewarded for it?
John, I do, because this is the engine of growth for the world economy. Innovation, the way we run our country, generally, I tend to be an optimist. The entire post-World War II experience shows us that it pays off over the long run to be invested in stocks, and that is different from different experiences. Now, it's probably a longer topic, but I am worried about the level of government debt, and this is kind of a longer-term problem that we need to think about.
Lisa agrees. Seb, it's good to see you. We'll have a longer conversation next time. Sebastian Page at T. Rowe Price. I think we all agree on that point. What would undermine that US exceptionalism? What would change that story? It's a big question you've got to ask.
Potentially, that's the reason why the government debt becomes an issue. There's also this issue of just politically, are certain countries trying to diversify away from dollar assets in some of their holdings? There's longer term sort of questions of the dollar's preeminence, but ultimately it does come down to the currency and to the debt markets.
That got a lot deeper than I thought. Seb, when you publish, come back and we'll talk about that paper, okay? Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. CrowdStrike, the cybersecurity company at the center of last week's massive IT outage, is blaming the issues on a defect in a content update. The company said a bug in the safety mechanism allowed flawed data to go out to customers. It added that a new check is in process in order to fix the faulty content validator that failed, and there are plans in place to stagger future deployments of updates before rolling them out at large. CrowdStrike CEO George Kurtz has been called upon to testify before Congress over the meltdown. And there is some rare good news for the beleaguered plane maker Boeing. The company resumed deliveries of its 737 MAX aircraft to airlines in China. The announcement comes after a roughly 2-month pause imposed by aviation regulators in China to review information about batteries used in cockpit voice recorders in Boeing's planes. Boeing is still grappling with leadership upheaval after being forced by U.S. transport regulators to slow production over concerns around its manufacturing safety standards tied to the Alaska Air 737 MAX door blowout. Elon Musk has confirmed that he has donated to a super PAC supporting Donald Trump's presidential campaign, but he's not pledging to give the $45 million a month that was previously reported. In a post on X, Musk acknowledged that he had donated to the America PAC, which focuses on get out the vote efforts, but he didn't say how much he contributed. America PAC raised $8.8 million in the second quarter, spent $7.8 million, and started July with a little less than $1 million of cash on hand. That's according to a recent filing with the Federal Election Commission. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, we'll get you some morning calls, plus Bloomberg's David Welch on Tesla's disappointing results and the delay of the robotaxi. That's up next from New York. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Let's start with stocks, then we'll turn to bonds. Equities on the S&P 500 down by close to 1%. There's a couple of reasons, literally two. We can talk about them throughout this morning going into the opening bell. One is Alphabet, the other's Tesla. I'll get to Tesla in a moment. I want to talk about the bond market. Yields lower by 2 basis points, 422.52. Lots of conversations about the shape of the yield curve, including one around this table. Lisa, what have you got?
Well, basically the curve steepening does continue. Basically have the narrowest or the smallest negative curve inversion for the 2s, 10s. Basically, 2-year yields are the least amount higher versus the 10-year yields going back to the beginning of this year. What this is basically a bullish steepening. This is a bull steepener. People expect the Fed to be cutting rates at a time where they can still avoid some sort of recession. So you're not necessarily seeing longer-term yields fall out of bed. At the same time, they're not either rising dramatically. So it's not necessarily punitive. It's sort of what people have been wanting to see at a time when the Fed is expected to cut
This
rates.
is what we expected at the start of the year. Then things changed. We had that inflation head fake of Q1, if you can call it a head fake, but certainly that changed the story. That's the bond market. Equity's a little softer. Let's get to the why. Let's get you some morning calls. One stock in focus, Tesla. First up, Citi, lowering its price target on the EV maker to 258, keeping a neutral rating on the name. The analyst saying the stock set up into October only improves if consensus is lowered and shares pull back. We're pulling back right now by more than 8%. Your second call from Cantor Fitzgerald, downgrading Tesla to neutral, but lifting its price target to 245. The analyst saying valuation is the reason behind the downgrade following lackluster earnings results. And finally, Wedbush maintaining an outperform rating and $300 price target on the name. Dan Ives is sticking with it. Ives is saying he wasn't looking for major fireworks this quarter and now expects the delayed robotaxi unveiling to unleash the beginning of a $1 trillion AI story. Okay, I've got another call for you, so let's squeeze a fourth one in. Pierre Ferragut of New Street Research. This is a rare downgrade for him on the name. Downgrade to neutral, 225. The headline, margins will take time to recover. There's a lack of near-term catalysts. We tactically downgrade the stock to neutral. I'm going to read some of this with you. It's just dropped in front of me, so bear with me. The stock is at our target price, trading on 50 times our 26 estimate. We see limited and unreliable valuation upside and limited risks of material positive revisions on that time horizon. The next inflection in the stock is unlikely in the next 12 months, 225. Target price. David Welch of Bloomberg joins us now for more. David, that's the south side. Let's deal with the numbers, what you and the team were looking at yesterday afternoon and what you heard on the call as well. What jumped out for you, David?
Well, look, the numbers for the EV business we knew weren't going to be great, but they just continue to deteriorate. And you know, a big number to look at is automotive gross margins, and part of this is they're not getting pricing. So down from 16.4 in the first quarter to 14.6. This is something that's just been declining for them for a while. So it's just a lot tougher for them to make a lot of money in the EV space. They do have the Cybertruck out there, but it's not selling in huge numbers. It is selling in good numbers for an electric pickup truck, but it's not the growth engine that Tesla really needs to get interest in the stock again. So we've got this AI story. Look, the revenue is strong, but a lot of that's the energy storage business and also regulatory credits. I think the credit side they can sustain for a while, but that's not why people buy the stock. So now we're sort of back to where Tesla was kind of over a lot of its history, where the fundamentals aren't great. So Elon Musk is bringing up this story that that the cavalry is just over the hill with a new growth engine, this time being AI and self-drive. That's really, I think, a tough one for investors to get their arms around. The reason there's still hope for it with Tesla is because a lot of people have lost a lot of money betting against Elon Musk. But if you look at autonomy, take Alphabet Inc. With Waymo, they've been testing these vehicles for 13 years, and still they only have kind of modest number of vehicles out there in certain markets, bringing in a little bit of revenue. It's really still in the test phase. So how does Tesla get out of that quickly to show big growth and that they're a leader in autonomy, which is a really difficult space and a very difficult technology to master? So you've got believers and doubters on that front, and Tesla, I think, is once again a battleground stock based on what you think about autonomy and their prospects there.
And David, based on the fact that people do believe in genius founders, and that has been one of the big arguments to go with Tesla. That's why it's not valued as a car company. It is valued as a company that innovates. This Pierre Ferragu call that John was reading out and talking about also includes this line: the FSD, full service driving, robotaxi, and Optimus remain longer term moonshots. David, do you get the sense that people are losing faith that Elon Musk can monetize some of his innovations and, frankly, truly genius types of ideas into something concrete?
Yeah, I do, and it's not necessarily that they're doubting that Elon can make AI and autonomy work. There's just a lot of doubt that anyone can. You've got some really good minds out there who've been working on this for years now. And also with AI, particularly in the auto space, with autonomy, it's never failed to disappoint. Is the problem. We had a lot of startups that got funded and they all died. Cruise and Waymo were, I think a lot of people thought they'd be doing more than they are right now, and they've been at this for a long time, and they haven't. And Elon Musk promised that there'd be a lot with autonomy years ago from this company, and now it's the new thing that he's got. But we don't see his cars being tested on the road in the way that we did with Cruise and Waymo and others. And you don't see a lot of miles being driven. You don't see a lot of reports with California, for example. So there's just nothing tangible for investors to grab onto and say, yes, the testing is going well, so we're going to see a real business here that rolls out and starts to bring in a lot of money. So the doubt may not be specific to Elon Musk and Tesla in this case. It's just that autonomy really is a difficult, technologically speaking, thing to crack, and also tough business case, because no one's really kind of figured out how much robotaxis can charge, what the margins are really like. So many question marks here going forward. It's hard for an investor to say, yeah, I'm going to bet on this in the next couple of quarters.
Yeah.
And by the way, we're only going to see prototypes in October. It's not like you're going to see businesses rolling out and bringing in revenue a month later in November. It could be well beyond that if we're only going to see prototypes in November. So look, a lot of to be seen here in the future from Tesla.
Elon Musk was pretty blunt about it. If you believe in it, stay in the stock, and if you don't, you should sell. David Welch at Bloomberg, which is pretty refreshing to hear from a CEO on a call. He's done that kind of thing before.
Ultimately, that is the biggest argument to buy Tesla, is that you believe in him and the promise of the company. If you don't buy it.
It's been a 12-month rolling story for a long, long time on that front. Up next, Michael Kushner of Morgan Stanley alongside Derek Burton of TD Bank from New York. This is Bloomberg.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
60 minutes away from the opening bell, equity futures pulling back by 0.9% on the S&P, a little bit more on the Nasdaq, given the weighting to the likes of Alphabet, the likes of Tesla, and that Alphabet story being punished around the investment side of things. Mandeep Singh of Bloomberg Intelligence was discussing that. That's also infecting the likes of Meta going into next week. So we're seeing a lot of these tech names pull back. We're down by 1.4 on the Nasdaq. I want to sit on the bond market just a little bit. On the screen, you'll see the 5-year, the 10-year, the 30-year. I've got the 2-year in front of me as well. We're down about 4 basis points on twos. 10s are down about 2 basis points. This yield curve is re-steepening, and later it's being led by what's happening at the front end of the curve. And you called it exactly what it is. It's the so-called bull steepener.
Yesterday, the 2-year auction, we laugh about the auctions. It was very strong, and that actually kicked off this front-end rally as people looked ahead to Fed rate cuts that would get ahead of any sort of downturn, which is the reason why all of the declines that you're seeing in the stock market are led by high flyers, not necessarily the most economically sensitive stocks. Here is the question: how much can we continue to see this, given the fact that the Fed is going to potentially cut rates in September? That's what the expectation is for the markets. But then it becomes unclear how much more they're going to cut at a time where there is a lot of debt. I think it gets more interesting heading into later this year. But right now, people are getting what they've been waiting for.
This move picking up this morning at the front end of the curve, would you associate any of that with what's developing in the equity market at all? Just a bit of a downdraft, bit of risk aversion developing there too?
There is an argument to be made that it will get the Fed's attention. However, the downdraft is being led not by necessarily the most consumer-facing names. It's being led by Alphabet. It's being led by Tesla. It's being led by a lot of names that have idiosyncratic problems. You still, though, have the likes of GM selling a record amount of big trucks. So you start wondering which messages you start listening to.
Tesla in the pre-market is down by about 8.5% in early trading. Ed Ludlow broke the story in the last month that robo-taxi unveil would be delayed. We got confirmation it's being delayed from August to October just yesterday. Ed's going to join us in about 15 minutes going into the opening bell. So some must-watch reporting for you in about 15 minutes. I want to turn the page to foreign exchange. Just look at the strength you're seeing in the Japanese yen for a third consecutive session. That's 3 days of yen strength. Monday, Tuesday, Wednesday. Again, dollar-yen gapping lower by 1 full percentage point. There are talk about rate hike conversations taking place over in Japan and elsewhere too, at a time when we're talking about rate cuts here in America. So that's the divergence people are looking for.
Which is the bigger pull right now? Is it the increasing expectation for rate cuts in the U.S., or is it the increased likelihood of a rate hike over at the Bank of Japan next week? How much does the Bank of Japan dial up 1-800-POWEL and say, what are you going to do? And then we'll figure out how much we really need to do.
What did Lagarde say about the Federal Reserve? We're Federal Reserve independent or something like that. They try to make that point a few times. I'm not sure how independent the BOJ is of what the Federal Reserve's been up to over the last few years, given what's been developing in the FX channel on dollar yen. Dollar yen around 154. Under surveillance this morning, President Biden delivering a primetime Oval Office address tonight at 8 p.m. Eastern Time. Biden addressing his decision to end his presidential campaign with just over 100 days until the election. First sight of him yesterday, since late last week.
Right, and he said he was doing well, and reporters were heckling questions at him. But tonight, this evening, we're going to actually hear from the president after he released this letter, and he's going to outline why he decided to step aside. I find it so interesting because, of course, the entire month, his story kept changing. It was Lord Almighty, it was the polls, then if there was a medical illness, and then it basically came down to his own party. Chuck Schumer, Nancy Pelosi, and the dozens of Democratic lawmakers that came out and said, our chances are going to be hurt if you remain at the top of this ticket. Interesting, the former administration, Donald Trump is writing a letter, or his lawyer is writing a letter to the main broadcast network saying, actually, given the legality of this, it sounds like it's a campaign speech, because he's going to endorse Harris, I imagine, on camera. They want equal time.
What kind of debates are we going to get between Harris and Trump? Do we know?
Trump said yesterday he's preparing to debate Kamala Harris, and that he even would be up for more than one.
Okay, let's see how many we actually get. September time, am I right?
September
is like the date in the diary, Bramo?
Yeah, but
that one?
on what network? There's some
We're going to have arguments over that now, too?
Oh, yeah.
Currently ABC.
Right, but he is pushing back.
Trump wants it now on Fox. But maybe if he's willing to do more than one with Ms. Harris, maybe Fox will get one. Or Bloomberg. We do an economic debate.
You want to do a proper economic debate? You know where we are. There might be some interruptions along the way. Can't guarantee that we'll sit back and won't moderate, but we'll be here for it. They're not going to do one now, are they? Probably not. Okay. More trouble for the airline industry. Southwest now facing an FAA audit over a series of recent safety incidents, including an April flight that came within 400 feet, just 400 feet, of plunging into the Pacific Ocean. Every time I hear that story, it's frightening. Anyone that's flying to Hawaii, just awful. Elsewhere at Delta, news not great there either. In the crosshairs as the Department of Transportation investigates its handling of last Friday's global technology outage. Flight cancellations continue this week. There is some hope that by tomorrow, things get back to normal based on recent reports. So that's the latest on Delta. Let's turn to this. And I think this is really noteworthy this morning. On Bloomberg Opinion, former New York Fed President Bill Dudley out with a bold call, saying the central bank needs to move, writing this: the facts have changed, so I've changed my mind. The Fed should cut, preferably at next week's policymaking meeting. Although it might already be too late to fend off a recession by cutting rates, dawdling now unnecessarily increases the risk. Joining us now to discuss is Michael Kushmer of Morgan Stanley, alongside Derek Burton of TD Bank. Michael, I want to come across to you first. What did you make of Bill Dudley's note this morning? Let's go. Let's move.
Well, we've moved a long way in terms of the actual economic performance of the U.S. economy. We're growing much slower than we did last year when we had all the bull market expectations of rate cuts. We got through the inflation blip in Q1 where we had the surprising very sharp increase. Now we're back to that deteriorating trend or improving trend of inflation. By the end of the year, we're likely to get to sort of the Fed's forecast for inflation targets. So we should be having less restrictive policy. But the question is how much less restrictive policy?
I can feel the consensus move, and I think we all can, based on the conversations and how they've developed over the last few weeks. But things are still pretty split. Goldman say, why wait? We had Barclays on the program yesterday saying, why not wait? Derek, which camp are you in going into this July meeting?
I'm in the wait camp. Things are slower, but they're not slow. And we'll get evidence of that in tomorrow's GDP data, personal spending data on Friday for June. Inflation has rolled over, which is great news, but you still have an economy that's fairly resilient. And Powell's been saying all along that resilience gives the Fed it affords more time to be patient. So I do think that taking July off and moving in September probably would be the best bet.
Michael, this is sort of consensus that September is the right time to go, that there isn't really a chance of dramatic weakening. And yet in the tone that we heard from Bill Dudley and the tone that we've heard from, say, the Redfin data we've been talking about this morning, about housing deals falling apart at a record pace in June, how much is there a sense that actually the economic data is moving in real time and suggesting more of an urgency?
I don't think there's so much of an urgency for the whole economy as a whole. Clearly, certain interest rate sensitive sectors, whether it's commercial property, office property, even more residential property, is under stress from high interest rates. But a lot of other sectors of the economy are doing just fine. In fact, the goods producing sector, manufacturing output, is up quite nicely. Talking about the old economy versus the new economy is doing just fine. But the point, I think, is if you compare what today's situation, say 1994, 1995, Greenspan pivoted very quickly from rate hikes to rate cuts in modest rate cuts in 1995, which kept the expansion going. Policy rates today are restrictive. Why not have less restrictive policy? Not easy policy, but less restrictive. The economy's growing 2%, inflation's close to target. Do we really need 5.5% interest rates? Get ahead of the game, so to speak, by nudging them lower, but not necessarily initiating a rate-cutting cycle going forward.
Derek, one argument against this, I presume, would be this idea of concerns that it could reignite inflation. That would be the only argument not to reduce some accommodation at this point, given that inflation is slowing. Derek, are there signs that inflation truly is sticky and could reaccelerate, even with a 25 or 50 basis point rate cut by the Federal Reserve?
Yeah, I mean, just look at the service component. It's still quite high. I know we've seen some improvement of late, but I don't think the inflation dragon's been fully slayed yet. And I am on the camp, our baseline is in the camp that, that chance that this is a false dawn, we're going to see another big leg up in inflation. We don't buy into that, but you can't rule out the risk. And for a central bank that is a risk manager, clearly they're taking that into account. So I'm worried still about service inflation. The job market, again, has slowed. Vacancies have come down, but real wages are still positive growth. And, the employment market is still quite strong. So, one can't throw out this notion that you could see a bit of a pickup in spending above trend from below trend in Q2 to above trend in Q3. And I think these are the things that the Fed has in the back of its mind when it's trying to balance. Do we move sooner or do we move later?
Derek, they're trying to build confidence about getting back to 2. You're concerned. Is this about returning to 4 or getting stuck at 3?
No, it's getting stuck at 3. I think, again, things have changed. I think we need to acknowledge excess savings have been pretty much fully withdrawn, and things have slowed. And those rates that Michael referred to are biting the housing market. Some of these areas are showing more evidence of struggling. And so I don't think we're in an environment to see inflation go back to 4. Now, of course, anything's possible. We're looking at some of the shipping rates backing up. Who knows geopolitically some of the risks. These are not, in the next month or so, but going out next 3-4 months, there are lots of question marks. But yeah, the 4% world just doesn't seem like it. I would put a very remote odds on that.
You gave a nod to the bond market, so let's talk about rates in the bond market. Michael, I want to talk about that now. Lisa's led this conversation this morning. 2-year versus 10-year, negative about 17 basis points. The curve is uninverting, let's call it that, sort of normalizing. I'm not sure we can call it steep. You can say it's steeper, but it's still not steep. Let's put it that way. Still very much inverted. There's 2 ways you can uninvert. It can be led by the front end. 2-year can rally, rate cutting cycle off the back of much weaker than anticipated data, or it can be led by the long end. Long end sells off, yields pop higher, and there's plenty of reasons for that to happen. What are you expecting from the yield curve, and what drives either side?
I think it's clear we're moving to a rate-cutting cycle of some sort. I think a lot of it has been discounted, if not all or more of it's been discounted today with 2-year notes where they are. I don't think the Fed's going to cut rates enough over the next 6 to 9 months to justify 2-year notes, 4.25 and lower than that. Back end, I think if the Fed is clearly moving in advance of economic weakness, if they do move 1 to 2 rate cuts this year, another one in Q1 next year, it boosts the confidence in the long end of the yield curve. It may slow down the inflation progress on that front, but the balance would be I'd rather preserve employment gains rather than disinflate faster than otherwise. So I think they're balancing off those 2 types of risk, which leads both to steeper yield curves. Moving too quickly or faster than the economy weakens will bolster long-term yields. On the other hand, if they wait too long, long-term yields may continue to drift lower.
It sounds like both you, Michael, and Derek are kind of talking as though you disagree with each other, but agree a little bit more than it actually seems. And it's sort of compelling to me that you said that the 2-year yield kind of has gone pretty far in terms of how many rate cuts it's already priced in. Are you saying that it's something you should fade, the rally at the front end?
Thinking about, because markets tend to overreact and overshoot. We've seen that. We saw that the fourth quarter of last year, where we had this major rally with 6 rate cuts priced in for 2024, and obviously it didn't materialize. We had a major sell-off in Q1. So I think that I'm not talking about a major sell-off because we're getting closer and closer to that transition point to actually cutting interest rates, as opposed to speculating about them at some point in the distant future. But I do think there's likely to be disappointment as how much actually happens over the next several several quarters, but the data today has been leaning that direction. We've had, until just recently, weaker economic data, weaker labor market data in some ways, and we've had better inflation data. So how this is not good for bond yields or for expectations of rate cuts, but the cumulative amount seems to be overshooting to the upside. So at some point, if we get 4% 2-year notes, barring some catastrophic risk factor in the world, which flight to quality or flight to risk-free assets, otherwise it looks like we're going to be pretty solid right now.
And Derek, it does seem like you pretty much agree that basically this is just a matter of when they begin to start to tweak some of the policy, not necessarily whether we're entering some massive recession or whether we're actually going to grow strongly. Is there something in the data that gives you confidence that we are not seeing a rapid deterioration that could lead to a more pernicious weakening, which is what basically was sort of the implication of Bill Dudley's column?
Yeah, I think, the June numbers, it's only 1 month, but certainly we had a series of downside surprises on data. Now is the pendulum swinging a bit towards some upside surprises. It seems to be the pattern of the U.S. economy. You get 3 or 4 good inflation reports, and then, 2 or 3 bad ones. So, I just think when I look at the U.S., productivity is still very strong. Employment is still healthy. It's the economy I still think that stands out. So I had not of the camp that we're going to, get close to recession in the U.S., that we're going to sort of grow along at around 1.5% to 2% clip sub-trend, sort of that Goldilocks type environment, and then we'll, avoid the worst case scenario. As Michael mentioned, there are lots of potential risks. The election, some of the uncertainty there, geopolitically, a lot of potential surprises. But if I look at the U.S. in and of itself, I think it'll do just fine.
Derek, thanks for being with us this morning. Appreciate it. Derek Belton there of TD alongside Michael Kushmer of Morgan Stanley. These conversations take on additional importance given we get jobless claims tomorrow. We get some PMIs a little bit later as well, 9:45 Eastern time, so look out for that. Those PMIs coming from S&P Global for the United States on manufacturing and on services. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. AT&T saw a second quarter subscriber increase thanks to ongoing promotion and lower churn rate. Shares higher by nearly 3% in the pre-market. AT&T had its first year-over-year increase in new monthly phone subscribers, while the number of overall cancellations fell, likely in response to a marketing push that gives new and existing customers the same deals on new phones and plans. And a bit of good news if you're still looking to travel to Paris for the Olympics. According to travel insights company Lighthouse, hotel prices for the Summer Games have fallen to almost half of their peak rate. Accommodations are now being listed for an average of $340 a night between this Friday and August 11th. That's down 41% from the peak rate of $575 around 11 months before the Games. Meanwhile, a Mediterranean heat wave is set to hit the European continent over the next few days, with Spain bearing the brunt of it. Temperatures will climb as high as 115 degrees Fahrenheit in the Guadiana River Valley, Sevilla, and Cordoba on Wednesday. Most of the country also faces an extreme risk of wildfires, according to local forecasts. Meanwhile, temperatures in Greece have cooled slightly after weeks above 105 degrees, but wildfires and violent storms still remain a threat. There were 62 wildfires in the 24 hours through 6:30 p.m. on Tuesday. And that's your brief, John.
Danny, thank you. That term, heat wave, has a very different meaning to anyone in the UK. It means this: summer, it lasts about 3 days, and it's the high 80s. You've lived it.
Sometimes, though,
right?
it is like a week. It's very exciting if it's like 7 days.
Get like 3 to 7 days, game on, summer, heat wave, everyone goes nuts. Everywhere else it's like dangerous. In the UK, it's summer.
Okay, it's a little bit different when it's the 80s for a week versus, 120 where
people get very excited about it.
Love the British
jumping
summer.
in fountains, stripping off, taking days off work.
Go to the heath.
Too hot. Up next on the program, setting you up for the day ahead. From New York City, you're watching Bloomberg Surveillance.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Equities on the S&P 500 shaping up as follows. Futures, negative. We're down by almost 1% going into the opening bell. The opening bell about 40 minutes away. Your trading diary looks like this for the next couple of days. US PMI data coming at 9:45 Eastern. At 2 p.m. Israeli Prime Minister Benjamin Netanyahu addressing Congress. And after the closing bell, more earnings. We'll hear from Ford and IBM. Then at 8 p.m. Eastern, President Biden addressing the nation from the Oval Office. Thursday, we'll get US GDP plus another round of jobless claims. And rounding out the week Friday with unmatched sentiment and PCE. Max 7 earnings picking up again next week. We'll hear from Microsoft, Meta, Apple, and Amazon. We've had a flavor of things in the last 24 hours. Ed Ludlow leading the coverage, along with the rest of the team here at Bloomberg, on the likes of Alphabet and Tesla. Ed, one name, let's talk about it. I want to get to Tesla before we turn to Alphabet. Sure. You nailed it alongside Dana Hull when you said that would be delayed. The robotaxi announcement from August, it's been pushed back to October. You listened to that call. What did you take away from that call with Elon Musk?
Yeah, it seems a strange thing to say, but the idea of a couple of month delay for prototypes now just doesn't seem that important. I mean, the stock is down 8.5%, and the conclusion, which I'm pretty confident in, is that in the near term, the core business is suffering. 4 consecutive quarters of profit missing estimates, while delivering electric vehicles, the business of, is hard right now in the moment. But the main takeaway is that investors just don't see the big picture still. They don't see the jump of all the narrative and excitement around the full self-driving software to a world where that's the biggest part of the business, along with the Optimus robots. And, that's really reflected in the pre-market trading this morning.
So this stock is struggling. Another one, and I have to say it's a surprise, so let's talk about it. Alphabet. Yeah. Alphabet numbers weren't bad. Stock is down in the pre-market by 4.5%. You spoke to Ruth Porat, I believe, in the last 12 hours or so, Ed. What's the takeaway from that company?
Well, Ruth Porat had an opportunity to give the street more, to give the market more. I think when it comes to a name like Alphabet, and indeed the Mag 7 or rest of that had come, investors expect, they demand the evidence that you're willing to put money into and fight in the competitive field of AI and AI infrastructure. But they reserve the right to be disappointed if there's no immediate, top-line growth to show for it. I don't want to kind of dwell too much on how the sausage is made, John, but it was interesting because on the call with Ruth, what happens is we speak to her just before the analyst call, right? And I asked her, did you note that AWS gave us a revenue run rate figure specifically for generative AI? Would you also be willing to do that? And her answer to me was, well, I'm going to talk about that on the call, so I'll give you another question. And on the call, what happened is she explained that year to date, AI infrastructure and generative AI had generated, quote, billions of dollars of revenue. But that's a bit of a hedge. AI infrastructure and generative AI is basically the entirety of their cloud business. So I think that, in summary, the stock down 4.5% in the pre-market. Investors said, show us something. You've spent a lot. They raised their capital spending commitment to about $1 billion more than the street was anticipating in the quarter. Give us some sales. Give us some data on that side.
Well, Sebastian Page was on earlier. He offered a bit of a psychology class, and he said the secret to happiness is low expectations, which makes me wonder, are Google investors bound to be unhappy because expectations are just so high?
Yeah, I'm not an investor, nor am I a psychologist. I'm a lowly and humble reporter, but that's the problem. You know, we went into it with the expectation that because of all the headlines on enterprise engagement with AI, that would translate to boom. The problem that Google in particular has is that it is, at this point, a pretty distant third place player in the cloud market, where AWS and Microsoft Azure do have tangible, substantive evidence that they're taking money to the bank from the infrastructure investments they've made for AI, the OpenAI investment in Microsoft's case in years gone by. The other thing as well is, like, AI is super exciting, and then the main message from management is the biggest contributor to growth this quarter was search, the good old-fashioned bread and butter business. And I think psychologically, to borrow that term, Lisa, that also impacted investors because they were like, oh, I thought we would have moved on from search by now.
Ed, I just want to go back to Elon Musk and Tesla. There's a little bit over 100 days to...
Every day, let's go.
Well, a little bit over 100 days to the election. Where does he stand right now and how much money he's giving the former president? Because
you're talking about the 45 million figure. Yeah. No, I'm actually really glad you asked. I would just point out one thing. On July 12th, Bloomberg reported that Elon Musk was making a, quote, substantial contribution or donation to the America PAC, but that it did not disclose a specific figure and cited anonymous sources. I believe it was the New York Times that ran with the $45 million figure, but at no point did Elon Musk say publicly that he would contribute $45 million, nor did Bloomberg report that themselves. So my take on this is just that Musk is confirming the original report from July 12th. And a little detective work along the way would show that it's kind of been a circular route to get there. But that's what happened in last night's comments, or sorry, in the podcast comments and his clarification on the earnings call.
Ed, super sharp reporting, sir. As always, it's good to catch up. Ed Ludlow there of Bloomberg on the latest from the West Coast on some of the earnings. Then we can take a step back. We've got about a minute. Just some takeaways so far this morning. Momentum building. A lot more people starting to sound like Mohammed Federal Reserve. And then on the politics, and I think we're all on the same page here, just the amount of companies that are coming out and saying, you know what, might be time to pause and wait to see what happens in November.
It feels like we're at a pivot point, both with growth as well as just how much companies have the conviction to make big moves because of the political uncertainty, the paralysis that we were talking about with Sebastian Page.
I feel like the C-suite has just woken up to the reality I've been living. This is an uncertain election environment, and the consequences for 2025 are going to be impactful for the market and business decisions. But tonight, we will see the president. 1 month tomorrow since that worrisome debate that sparked all these concerns.
8 p.m. Eastern Time. Look out for that. Coming up tomorrow, Anastasia Amoroso of iCapital, Stellantis CEO Carlos Tavares, Libby Cantrell of PIMCO, and Michelle Girard of NatWest Markets. From New York, that does it for us. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
That are off bigly. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shanali Basak. And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, tech disappoints. Tesla posts its fourth straight profit miss as Alphabet faces pressure to keep up on AI.
Blackstone's mortgage REIT cuts its dividend by 24% just days after Carson Block warned us that it may face a liquidity crisis.
And Wall Street's Democratic donors spring into action to quickly fill Kamala Harris's campaign war chest. We got the scoop on their plan. We'll bring that to you. But let's take a look at markets with about 30 minutes until the bell rings because it is not pretty. Of course, we got earnings from Tesla, from Alphabet. They did not go over too well. You can see the S&P 500 down about 1% pre-market, even worse. If you take a look at big tech, the NASDAQ 100 off by nearly 1.5%. The bond market may be a haven bid coming through here. You have 10-year yields down about 4 basis points, Matt.
All right, I have a chart for you, Katie. This shows the rotation. So what I've got here is the Russell 2000 minus the Mag 7. Remember, we're watching these small caps for a resuscitation in earnings season. Certainly investors think it's happening, bidding these small caps up, bidding up the Russell 2000 over the bigger cap tech stocks. Shanali?
And in order to rotate, you have to sell something, and Tesla shares are being sold off right now. Shares slumping after its fourth straight quarter of disappointing profits, delaying its robo-taxi unveiling to October. We have Tesla down more than 8% pre-market. Alphabet also down 4.3%. Alphabet shares dropping as investors wait for AI to finally start paying off.
Yeah, and it's not been doing that. Certainly not. In Europe, we've got bad earnings news there, right? We had LVMH, Louis Vuitton sales actually expected now to drop for the full year rather than stay flat. Deutsche Bank posting its first quarterly loss in 4 years, saying it's possibly going to pull back on a second buyback. And then you get into the U.S. and Tesla's no good as well.
I was going to say, you're starting the show with Europe. I thought that you were all about the USA.
You just see the bad news coming through from the continent across the Atlantic to us.
Fair enough, and there is a lot of bad news to parse this morning. Tesla shares, Elon Musk saying, if you don't believe in autonomy, don't have this stock, sell the stock, and certainly people are doing that this morning.
Yeah, remember when glass half full math existed yesterday? It's a little glass half empty today, isn't it? But Tesla is the big story to start.
Yeah, I mean, but there are many more, right? Otis isn't selling as many elevators.
Oh, no.
And Aston Martin, those revenues dropped 11%. On the earnings call, though, for Tesla, let's focus in on that. Elon Musk spoke about the robo-taxi delays.
I wanted to make some important changes that I think would improve the vehicle, the sort of the robo-taxi, the main thing that we're going to show, and we're also going to show off a couple of other things.
Joining us now for more is Ed Ludlow, co-host of Bloomberg Technology. And Ed, you watch this and report on this company very closely. In fact, you broke the news that the robo-taxi would not be coming in time. How are investors taking this?
Yeah, you know, in the first instance, the headline that the robo-taxi unveil will be October 10th instead of August 8th. I don't know that that's what the anxiety in the market is. You know, it was only ever going to be prototypes anyway. On the call, you know, a couple of analysts had a stab at trying to get Elon Musk to explain the bigger picture, which is that ultimately Tesla hopes to operate a proprietary ride-hailing app, similar to Uber, where you request a car that drives itself, and it is either an existing consumer car with the necessary hardware or software, or it's the purpose-built robotaxi. And if you read the language closely in the shareholder deck about how they intend to manufacture that, it would indicate that it is a distant product well beyond 2025, or at least after 2025. So I think that's the problem. Investors are like looking at all of this information, digesting the call and saying, I don't see the jump from where we are with full self-driving software being tested in consumer cars to like this very big end goal.
You know, you think about the momentum, and this morning New Street Research coming out with a downgrade of Tesla's stock, saying that margins will take time to recover. How much patience is there now among the investor community and the sell side?
Just looking down at my my Bloomberg terminal, because I think that was Pierre Ferragu. Am I right about that? I think that's the first time he's not had a buy rating or a super bullish call on the stock for like 3 years. So that's kind of interesting. You know, however much credence you put to the sell side, you know, the reality is that also the fundamentals of its core business are also dwindling. I think you pointed out, Shanali, 4 consecutive quarters where the bottom line has missed expectations. Now, a bright spot was that this was a record quarter of revenue, 2% year-on-year revenue growth, when the street thought it would be a continuation of decelerating or shrinking year-on-year revenue growth. And some of the other parts of its business outperformed: energy storage, battery installation, an incredible number of ZEV credits, for example. But they still have a problem with selling EVs right now. And they listed all the factors behind that, ranging from the economy, competition from hybrids, and automakers kind of not helping them out, right? We think, you know, we talked a lot on this show about everyone bailing, you know, going back to combustion engine or hybrids, and Tesla pointing out that's not helping us in the here and now. That's kind of got the established Wall Street investor, who may not buy the thesis that long-term cars are the smallest part of the business, a little worried.
And Ed, just quickly here, I want to talk about the ripple effects of what we heard from Elon Musk last night, specifically when it comes to NVIDIA, which is down over 2% pre-market. We heard Musk basically say that there's been a doubling down that they're doing on the Dojo supercomputer, that Musk is concerned about getting enough NVIDIA chips. Walk us through those comments, just briefly.
Yeah, in training its foundation models or transformers, Tesla uses both its own proprietary silicon, Dojo, and it uses NVIDIA's H100. Musk said it's been really hard to get hold of the H100 when they need it. In other words, NVIDIA is supply constrained, and so they are going to focus on their own chips out of concern that they won't be able to access NVIDIA's tech as and when they need it. Supply constraint is usually a good thing for the seller, because demand outweighs supply. But clearly, I think everyone's looking at NVIDIA's ability to deliver its tech to a key name.
Yeah, it's a fascinating point there that those supply constraints, they're good for a certain amount of time, and maybe we're reaching that inflection point here. Bloomberg's Ed Ludlow, thank you so much. Let's keep the conversation going now with Callie Cox. She is Chief Market Strategist now at Ritholtz Wealth Management. Callie, it's great to have you with us, especially as we finally have some real earnings to talk about. And so far, not going over too well. When you think about what we learned from Alphabet, what we learned from Tesla, what can we extrapolate out to the rest of big tech and really the rest of the market from there?
Big tech has been a victim of its own success here. And I say that because if you look back at the little bit of earnings season that we've seen, we've actually seen some quite good results. 80% of companies are beating earnings estimates. Revenue is coming down, but this is a cost-cutting environment for corporate America. So that's frankly okay with me. I'm looking at the everything else when it comes to earnings season. Obviously, tech is a big part of the market. Tech has been the big story for most of this year, but everything else is starting to contribute in. And I'm fine actually giving away a little bit of tech strength if it means that more stocks can participate in this bull market.
So does that mean actually selling tech stocks, the big mega caps, taking those profits to buy smaller cap stocks?
Well, yeah, I think if you're a tech investor, I think if you're heavily concentrated in tech, you're probably sitting on some nice gains right now. And the risky side of me, being an analyst who looks at the pros and cons, would tell you to consider rebalancing. Understand what's in your portfolio, but understand how you got here. And frankly, we're telling our clients to do that as well. Look for value in this market because there's a lot of value and it's not just a tech-focused market anymore.
Callie, if you take a look at the expectations for rate cuts, yes, there's one for September, but you think about what Bill Dudley wrote this morning for Bloomberg Opinion, the idea that waiting that long could create unnecessary recession risks here. And if you get to the point that the economy weakens, then is this rotation really sensible into those small and mid-cap names?
I read Bill Dudley's opinion this morning. I certainly think the Fed has an argument to cut in July. I'm a little less scared of the future. I still see a solid job market. I still see contained layoffs. I see profits rising in corporate America, maybe outside of tech. So I think the Fed has time to wait, and this Fed is very measured. They like to give you a hint before we actually see any kind of big rate switch or rate move coming. So I wouldn't be shocked if they waited until September. I think they have the breathing room to do that. But with where inflation is now, or inflation data that we're seeing, I wouldn't be surprised if they went ahead and did the thing in July.
Yeah, it remains to be seen, of course, to your point. This isn't a Fed that likes to surprise the market, but the data has definitely been interesting. But let's focus in a little bit more on small caps. We actually heard from Julian Emanuel a little bit earlier. Let's take a listen.
When an asset class has been abandoned as much as that, when it is trading at a valuation discount to history versus, large caps and NASDAQ as it is, and when you have, in our view, policy behind you in an environment where even if we do have a downturn, it's likely to be a mild recession, that's an environment that we think is going to work.
That, of course, was Julian Emanuel of Evercore ISI. And on that point, Callie, obviously Julian sees some durability to this small cap rally, but it seems like a lot of the bullish notes are pinned to the fact that valuations for small caps are so depressed. When you look at the fundamentals, though, are they there?
First of all, I agree with Julian there. If you look at where small caps were relative to large caps, the discount between small cap valuations and large cap valuations was at a 20-year high before this big rotation happened post CPI report. Small caps have been so unloved for so long that I'm not surprised that we've seen this frantic rotation back into small caps and rate sensitive sectors of the market. I think the question is how far it will go right now. I think there could be some bumps because markets frankly just don't go straight up over time. And there are some concerns there, right? We still see a lot of value in small caps, but at the same time, the question that we're grappling with right now is how far can it go? And I think that it's a question that's hard to answer right now.
Callie, I think it's pretty clear that a lot of people in the market think that things could get choppy before they get better, Julian Emanuel being one of them, Mike Wilson also over at Morgan Stanley. If you think that we could hit some road bumps before the election in the stock market, why not wait? Why not wait until valuations correct a little more?
Well, look, there are so many good reasons to invest in the stock market right now. I always remind people of the upside risk, for lack of a better phrase. If you discount this market could pass you by. And right now, we're staring down celebratory Fed rate cuts, the kind of rate cuts that come when the Fed feels like it has the economy back in balance. And we're doing that against the backdrop of a strong market. I think it would be foolish to discount where the market could go by now. So we're telling investors, believe in this bull market, understand that there's really strong support, especially if we see this rotation continue. And until we see a breakdown in the job market, it doesn't make sense to abandon stocks. But it isn't a zero-sum game, right? Maybe look at bonds a little bit more, maybe look at cash a little bit stronger, even if rates are coming down a little bit. Understand that you can take on a sanity hedge while still being optimistic about the future.
All right, Callie, thanks very much. Callie Cox there, Ritholtz Wealth Management, giving us her view on the market. We are looking at the market broadly down in terms of futures. There is some deal news here. T-Mobile and KKR are going to establish a joint venture to buy Metronet. That's a headline just crossing the terminal. And in the telecom sector, we also saw AT&T add more subscribers than had been expected. That stock is up in the pre-market. We'll dig deeper into those moves after this. Coming up, Blackstone cutting its dividend on its mortgage REIT by 24%. More on the move and why they felt it's necessary next. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. Sales growth at luxury powerhouse LVMH slowed last quarter as wealthy shoppers in China reined in spending on pricey Louis Vuitton handbags and Christian Dior couture. The company has proven more resilient than other luxury houses to China's economic slump, but this quarter sales tumbled 14%. Meanwhile, Deutsche Bank shares are plunging in Europe after seeing its first quarterly loss in 4 years. The bank says it will most likely refrain from a second share buyback this year. It's Germany's largest lender. It also warned that provisions for loan losses will be higher this year than it had previously expected. And Blackstone Mortgage Trust is cutting its dividend by 24% on rising defaults, increase in struggles for borrowers to either make payments or refinance. The board of the $3.4 billion real estate investment trust, known as BXMT, authorized the repurchase, though, of $150 million of stock to lift the value of the shares. Shonali?
Meanwhile, short seller at Muddy Waters, Carson Block, made the decision to short BXMT back in December. He was on air on our program just 2 weeks ago and explained the rationale regarding the dividend.
Our thesis from when we unveiled it in December of last year is that in the second half of this year, BXMT is going to cut the dividend. A lot of these loans are in trouble. BXMT has not trued them up in terms of the risk ratings. So we believe that as more and more of these loans are allowed to pay in kind, that in the second half of this year, BXMT is going to have to cut the dividend.
Want to now take a quick check on some of Blackstone's competitors here, because of course there are a lot of publicly traded REITs, some of them now down pre-market. KKR Real Estate Finance Trust dropping 1.8%, the worst of the pack really, but Arbor Realty, Apollo Commercial Real Estate also down on the day. Joining us now for more on Blackstone, we are joined by Nir Kesar of Bloomberg Opinion. And you think about Blackstone, and the reason it becomes worrisome is because Blackstone is kind of the gem in the room. It's been considered the safer of assets. And if you extrapolate across the real estate industry and other places, you could see problems. What do those problems look like?
Good morning, Shonali. Yeah, I mean, I think we have to talk about the big question, which is when we're talking about commercial real estate, are we going back to pre-pandemic work life or are we not? And this is something that we've been struggling with for years. And my view since the beginning, since the pandemic, has been that we are not. And the reason we are not is because it doesn't make any sense. Now that we have the technology to be able to do work anywhere, it doesn't make sense for someone who lives in a suburb to commute an hour each way to go into the office and do the exact same thing in the office, sit at their desk and respond to emails that they could do at home, or they could do in an office closer to their house, or however alternative arrangement that you can conceive. And therefore, I think because of that, we are in a process of a multi-decade sort of secular change in where we work, how we work, et cetera. And I think there's a lot of denial about that. There's a lot of denial, I think, from, excuse me for saying, sort of older generation of workers who want to see us return to pre-pandemic levels, and also from commercial real estate investors who don't want to have to make hard decisions about taking losses, about converting real estate properties, et cetera. But the more we avoid this question, the more it's going to come back to us. And this is, I think, one of many sirens that are going to come
And
our
also
way.
from Blackstone, right? I mean, wasn't there denial there? I'm getting like Democratic Party vibes. Like, he's fine, he's fine, he's fine. No, he's not going to run. Do you get that too?
Well, apparently we're going to see President Biden at 8 p.m. tonight, so that'll be very interesting. But I mean, near to that point that there needs to be this realization of what you're saying, that things aren't going back to pre-pandemic levels when it comes to office occupancy. What does BXMT, Blackstone, and all these other REITs do? Because you take a look at BXMT specifically, they say that they've cut net exposure to offices by $1.4 billion over the past 2 years. They've cut the dividend. Is it enough?
Well, they're going to do the only thing they can do, I think, which is what you're referring to, which is they're going to pivot and they're going to make some, unflattering announcements along the way until they can pivot out of the space. And ultimately, whoever's left holding the bag will hold the bag. But I think there's going to be some bad news to come. And, whether it's enough or not, one way to gauge that is obviously by their exposure. But there's another way, which you can look at the historical yield on mortgage REITs, and you could see where they are relative to their historical average and their standard deviation. So, for example, I was looking at the numbers this morning. Right now, the yields on mortgage REITs are a tad bit above their historical average, which tells you that if there was any enthusiasm in the space, it's gone out. But it's not even a standard deviation above that average, which also tells you that there's a lot of downside still. If what I'm saying is right, ultimately, that mortgage REITs, commercial properties are going to suffer in the next 5 to 10 years, let's say, you're going to see more pain in those yields. And so I wouldn't say we're anywhere near distressed levels yet.
Nir, I don't know if I'm just a moron, but what does it mean? I know that I'm a moron.
You are not a moron.
What does it mean that they're cutting the dividend but then buying back $150 million in shares? What does that tell you about Blackstone's strategy or thinking here?
Well, the cutting, I think they're anticipating that there's going to be defaults, which is clear. I mean, that's one of the things we haven't seen yet, is the wave of defaults that are going to come, because there's some stub period. Interest rates went up, but there are current loans in process. Usually they would go to refinance them. Now when they go to refinance them, the interest rate's going to be a lot higher, and that's going to be problematic for their P&L. And so you're going to have defaults. And so I think Blackstone is trying to get ahead of it. By cutting the dividend, they're trying, I think, to conserve some cash. And by buying back shares, I think they're trying to, I don't know for sure, Matt, but I think what they're trying to do is they're trying to add some control to their own portfolio, their ability to pivot the portfolio into places that they think there's going to be a higher return and a lower risk going forward. that's my read of that, but I'm not entirely sure, to be honest.
You know, you think about the bid that you've seen in the banking sector recently, the KBW Bank Index, 5 out of 7 days has been in the green. And then you see this morning Deutsche Bank moving to put aside more money for souring loans in the real estate sector. And for those who don't remember, it was Deutsche Bank, JP Morgan, some of the biggest lenders, but of course the regional banking system now more exposed. Do you think what's happening at Blackstone signals more trouble than investors are currently baking in because they're so excited near about those rate cuts?
For sure. I mean, I think everybody's in denial about this is my broad view. The question is, who's going to be left holding the bag? I don't think we have our arms around this yet. How much exposure do regional banks have, and what does the quality of that exposure look like? Because even in a distressed market, which we're not there yet, but even in a distressed market, there's going to be quality among and along the commercial properties and who's holding what. And, you know, in general, the more sophisticated players tend to be savvy about holding higher quality. So knowing nothing, I would say that I would be concerned about the regional banks. But this will unfold, I think, hopefully slowly and not quickly. I mean, we don't want a crisis on our hands, but hopefully this will unfold slowly. There will be a wave of defaults. We'll be able to manage through it as an industry. And hopefully the folks who are holding the lower quality properties will be able to get some help. But, you know, that's, I think, best case scenario in my view.
All right, Nir, that's a good place to leave it. Always great to speak to you. Hope to do it again soon. That is Nir Kesar of Bloomberg Opinion. Now, coming up, we'll take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
All right, it's time now for Social Climbers, the companies making waves this morning. And first up, we have Texas Instruments. Sales forecast there stoked optimism that orders may now be on the rise. That's helping to counter fresh concern that was caused by peer NXP Semiconductors, which on Monday gave projections that fell well short of estimates. Next up, Visa posted quarterly revenue that just missed Wall Street estimates, a rarity for the world's biggest payments network. Worldwide card spending climbed 4.9% from a year earlier. And in the U.S., where Visa gets roughly 40% of its revenue, spending advanced 5.1%. Finally, CrowdStrike says that last week's meltdown was caused by a bug in a safety mechanism that allowed flawed data to go out to customers in a botched update. The firm, which is trying to piece together the series of events that led to one of the most spectacular rolling IT failures the world has ever seen, says that it will improve the testing of its updates. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Coming up, we'll speak to Rock Creep's co-chief investment officer next. This is Bloomberg.
what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
25 seconds to go until the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We have futures that are down across the board. Even the Russell 2000 futures are falling right now, so no rotation today. S&P futures down almost 1 full percent. Concerns after bad earnings came in from Tesla last night and then from Europe overnight. Can this market recover if the mega cap tech stocks aren't pushing up and we don't have the Russell 2000, the small caps in that rotation playing along? Let's go over to Katie Greifeld right now. She's got a look at your live index trade. Katie?
Yeah, of course, as the bell rings, you can see it's exactly like you said, a down day in the markets. Big tech not exactly coming to save the day. In fact, doing the exact opposite, because the S&P 500 currently off by about 0.9%. Your biggest loser, of course, is big tech, down 1.4%. And like you said, small caps, actually the relative outperformer, but still down by about 0.6%. Now, one stock we're keeping an eye on, of course, another earnings story here, but a good one. AT&T shares higher after posting a surprising gain in mobile phone subscribers. Shares currently up by about 4%, Shanali.
Also at the open, keeping an eye on Visa, down more than 3%, reporting a rare miss in quarterly revenue. Of course, not only that, sending the stock lower, payment volumes as well, Katie, on the decline relative to expectations here.
All right, Tesla continuing to fall after missing earnings. Again, it's the fourth quarter in a row where Tesla has missed earnings expectations. Also, it's delaying its robo-taxi. They're not going to have a humanoid robot until 2026. They're not going to have a cheaper car alternative until, at the earliest, the first half of next year. Let's get over to Abigail Doolittle. She's got a closer look at the stocks.
So investors are a bit disappointed here, Matt, but I would argue that maybe it has to do with the fact that this stock off of the April lows until the recent highs up about 90% trough to peak. Today, down 9.2%. This is the worst day since January. And as you mentioned, they did miss the earnings estimate by about 14%. That had to do with the gross margin. But similar to Amazon, I would say in some ways they maybe are pulling an Amazon. They are spending for the future. If we take a look at cars sold, revenue, this is getting lost in the shuffle, actually beat by 3.5%. They put up $25.5 billion in revenue. The amount of cars sold in the second quarter up sequentially, sort of around the mark for the last few quarters. So Elon Musk saying, if you don't believe in autonomy, then Tesla's not for you, encouraging people to sell. You did mention that they delayed the robo-taxi. This is all about the robo-taxi, but it's not just a car, an autonomous car that will drive people from point A to B. It's also about distributed power. It's about supercomputers. If we take a long-term look at Tesla, we were talking about this yesterday, Matt, in the Bloomberg terminal, we are going to see a beautiful uptrend, frankly, but you can also see that it goes wildly above it. Sometimes it goes goes a little bit below. What's interesting, right now, we are holding this uptrend perfectly, breaking out of the resistance. The RSI is climbing higher. So I would actually suggest that this chart, so long as these trends hold, and right now they are, points to the big future for Tesla, that it is about autonomy, and that investors, maybe new investors, will be coming in to really wrap their minds around an overall ecosystem of AI and autonomy.
All right, not really about a car maker, but more about a tech company. That's, I guess, the argument that bullish investors have been giving us for a long time. Abigail Doolittle, thanks very much for that. Joining us now is Alifia Doriwala, Rock Creek Group Co-Chief Investment Officer. And Alifia, we've had some pretty disappointing earnings news when you look at the macro implications of, Otis, the gigantic global elevator maker, having to cut its forecast. LVMH having to forecast sales that are down and a drop of 14% in the quarter. Deutsche Bank having its first quarterly loss in 4 years. And Tesla, of course, disappointing for the fourth quarter in a row. Are you worried?
I mean, I think this just shows how important earnings season is, right? So earnings season is obviously just getting started, but it is going to be extremely important for investors in the market, because up until now, the market and the investors have really had to care about two things, right? This year, one, what is the Mag 7 going to do? And two, data. It's all been about data, 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 inflation, interest rates, job reports, consumer spending, because that had implications for fiscal policy. I think today, as we start earnings season, it really is, what is the rest of the market, meaning those smaller companies outside of the mega tech, going to actually be able to meet or exceed expectations, so investors have the confidence to sustain this shift in sentiment that you talked about that we've been seeing and buy into the rest of the market. And as you mentioned, expectations have just been so high across the board going into the market. And so it's really not even just about big tech. I think it's about all these other companies, and will they be able to have the positive growth momentum that we want to see, to be able to have confidence to buy into the rest of the market as we head into the rest of the year, which is, I think we're at an interesting potential inflection point in the market today.
Alifia, when we take a look at certain companies, you look at UPS yesterday, you look at Lamb Weston today, shares sinking as much as 25% at the open, the biggest decline since March of 2020. You're seeing comparisons to moves that we've seen in tough times, 2008, 2020. I mean, how much negative sentiment is under the surface? You've seen a lot of bullishness, of course, in the recent months, but these one-off names are coming out showing you tough stories. How do you read that?
I don't think it's surprising that we're going to see pockets of softness in the market, given where we are today and where we've come from, right? But I will say that this is a great opportunity for active management. It's a great opportunity for fundamental stock picking. As a long-term investor, this is a great time to be looking at your active management, your active risk in your portfolio, because we are starting to see stock prices actually react to fundamentals. And I think this earnings season is really going to highlight winners and losers in the shorter term, but really set us up for longer term. Where are we seeing pockets of trends that we want to be able to invest in? I mean, there is so much innovation happening in the market, but it's over a longer period of time, right? So sometimes these shorter term noises around earnings gives us some data points to see where the longer term trends are going. For example, innovation in healthcare, energy transition, fintech. I mean, these are all areas we're very excited about. And we're starting to get clues from some of these companies in terms of how those trends are going to materialize, again, for the longer term.
So how would you go about action on those industry groups? I mean, what do you like specifically? Do you buy individual stocks? Do you want to track an index? Do you like ETFs? How do you do it?
So again, we are all about active management in this market, and going forward for the rest of the year, we think you're going to have to really be very selective. And so passive index investing is maybe not the best way to position your portfolio, rather looking exactly and specifically at who is actually going to be able to make money in which specific sector. And, we have the luxury of investing in both the public markets and the private markets. And so if you look at the private markets today, there's been a lot of, hurt in the private markets over the last 2 years, given how we've seen distributions coming from private companies, given the lack of IPOs. But it's a great opportunity if you have fresh capital and the flexibility and the liquidity to be able to invest into this market. So specifically healthcare, for example, precision medicine, efficiency and scale in medical services, preventive medicine, reimagining insurance, biotechnology. I mean, these are all areas that are ripe for investment and opportunity. But to your point, you have to be selective. Unfortunately, you can't just buy an index.
But to that point, I mean, we've been hearing that for a while, that it's a stock picker's market, especially, with the volatility around what the Fed is going to do, earnings sort of have and have nots there. But even still, you take a look at most measures of tracking active management. I watch ETFs very closely, for example. We've seen a ton of money come into active management, haven't necessarily seen the performance to match that. It's certainly quite hard to outperform the indexes that you say that investors shouldn't be buying right now. So what's going to change? Why would this experience be different?
Yeah, I mean, I think you have to, take what you've learned from looking backwards, but then look forward. I mean, I agree with you 100%. It has not been a stock picker's market up until now, but I think we're starting to see a fundamental shift in investor sentiment. And if we can let the Mag 7 lose a little bit of the control that it has had over some of those indices, over some of those markets, I think you're going to have a much more interesting market where you will have the opportunity. But again, I think it's going to depend on how we see earnings season play out, and it's going to depend on how stocks are reacting into earnings season. And I think we do have a political uncertainty with the elections in November. That's going to be an overhang on the market as well, right? That might have longer term policy implications for your portfolio that you have to think about. But in the shorter term, we also might see some more macro, I would say, headwinds in terms of the markets. And really, active management has had to suffer through those market headwinds for quite a while now.
Olivia, one thing I don't believe you mentioned in your list of exciting investment ideas at this point is artificial intelligence, or at least you played up other parts of that thesis. You have the Philadelphia Semiconductor Index, almost every stock in the red right now. It's down another 2% nearly today. NVIDIA is down more than 3% starting the day as well. Do you think that the ripple effects, the weakness you're seeing, for example, today in tech, has kind of an increased effect here on the semis, especially when you see kind of that negative sentiment feeding through in recent weeks?
So it's funny you say I don't mention AI, because I think it's almost like investors take it for a given now. AI is across every single one of your investments in your portfolio, whether you even know it or not, right? And it's beyond just investing in the inputs into AI. So looking at the semiconductor, looking at big tech, it's across every single sector and industry that I mentioned as well, because that's how the innovation is happening, the application of AI towards those sectors. And so, we are looking at how to invest in AI across a multitude of areas. But again, it's not a shorter term earnings season call, right? This is a 10, 15, 20-year trend that investors are really going to have to get right in their portfolio and pick their spots to be able to make money from how AI is going to transform sectors, and how fast AI can transform certain sectors.
Olivia, we thank you so very much for your time. That is Alifia Doriwala of the Rock Creek Group. And coming up, the analyst action that you need to know this morning, that's up next in our top calls. Stick with us. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about, how do I take everything that I know and I've learned and actually do the opposite? And I think that as a young Black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
All right, it's time now for Top Calls. Some of the analyst action in focus this morning. And first up, New Street Research cutting Tesla to neutral. The firm cites margins taking time to recover and a lack of near-term share catalysts for the downgrade. Tesla shares down by almost 11%. Next up, Morgan Stanley downgrading General Motors to equal weight. Analyst Adam Jonas sees little scope for further gains for the automaker. And finally, RBC upgrading Estee Lauder to outperform. The firm says that the risk to reward profile of the cosmetics company now skews favorably, Matt.
All right, very interesting. And I believe that company was founded here in New York City. All right, quick check on what's going on in stocks. We have a loss of more than 1% on the S&P 500 just 15 minutes into the session. The NASDAQ falling almost 2% here. And I think it's notable that the Russell is basically unched. I would like it. You know what? I've gone from wanting to see the Dow Jones Industrial Average on these boards to wanting my WEI function to have the Russell 2000 straight on the opening screen.
Of conviction.
Well,
shifting conviction.
Shifting. Well, I'm just saying.
There are other people shifting conviction this morning, too.
Great tie-in to Mr. Bill Dudley, which I'm sure we'll get to.
Some breaking economic news that we're watching here, just crossing as well. We've got S&P U.S. manufacturing PMIs at 49.5. We were looking for 51.6, so a little bit less than expected. Services PMIs a little bit better than expected at 56. We were looking for 54.9, and the composite at 55 is a little bit better than the 54.2 in the survey. Let's talk to Michael McKee about those PMIs and get the shifting views that these ladies were alluding to from Bill Dudley.
Well, first, PMIs. It's been a bit of a data desert this week. Now we get something that Wall Street can hang its hat on, which is the unfortunate drop in manufacturing PMI. Of course, next week, next Thursday, a week from tomorrow, we get the ISM manufacturing numbers, which will matter more. But this does suggest that there's still weakness out there, which will lead us into Bill Dudley in a minute. Services PMI, though, goes up. So the service industry is still doing reasonably well, and that is reasonably good news since that's the biggest part of the economy. And the U.S. is better off overall than what we saw in Europe today. Some really dismal numbers there where they're all testing 40s, not going into the 40s, going below the 40s in manufacturing. UK, the only real standout at this point.
And we are hearing from the Bank of Canada cutting its key interest rate 25 basis points. That was as expected. But like you said, it has been a data desert. I feel like we haven't seen you in weeks. We do get more data at the end of the week, which I'm sure we'll parse over PCE. But let's talk about Bill Dudley. We've been alluding to
the
it.
Bank of Canada.
Yeah.
I'm stuck on that for a second.
Back to back.
Yeah. And they were the first to cut, right?
They were the first to cut, and they've been looking at a real estate issue like we have here, and high mortgage rates, and
But they're doing something about it.
They're doing something about it. They feel they can, and as you were referencing, Katie, Bill Dudley thinks the Fed should be doing it not in September, but next week in July. And he quotes John Maynard Keynes saying that facts have changed, so I've changed my mind.
And his opinion, of course, carries some weight, not because of his current role, but the role that he did hold. And I mean, so he's changed his mind. He's saying next week. Is there any possibility of that happening? We were just talking about how this isn't a Fed that likes to shock the markets, and that would be shocking.
That would be shocking, and that's why I would lean against the idea. He's looking at the SOM rule as his major number, where if you go up half a percentage point from your low, you end up going into recession in unemployment. The Fed doesn't get unemployment before their meeting. It comes out the Friday afterwards, but it's not forecast to go up at all. It's supposed to remain at 4.1%. If that's the case, it won't trigger the SOM rule. But if it does, there'll be a lot of ex post criticism of the Fed. So it'll be interesting to see whether they at least say something about it. They're expected to set up the idea of a September cut.
You think about what Powell was saying about balancing growth and jobs at this point. It's not just about the jobs, is it anymore? What about the rest of the potential to slow down? A part of what Bill Dudley was saying here was this worry about an unnecessary recession being prompted by waiting too long.
Yeah, he doesn't expand on that too much, but it's an interesting point for him to make. And people have pointed to the Beige Book, which shows a majority of Fed districts see flat or declining growth, and some of the numbers that we've gotten recently, existing home sales yesterday, were bad, and then you throw in this PMI. So he's making the case that the Fed doesn't want to wait too long. What's interesting is, you mentioned, Katie, that he has influence, except not in the markets, because the betting in futures markets and interest rate swap markets shows that the markets do not think the Fed is going to move next week.
But isn't it fun to think about? Maybe don't trade on it.
Yeah, make my day more interesting.
Yeah.
All right, we do see the loonie erasing its gains.
The
Canadian dollar after the Bank of Canada cutting interest rates in their 25 basis points. Very interesting stuff. Michael McKee, thank you very much. Great to see you here in the same city as we are. You can follow the Bank of Canada news conference by typing Live Go on your Bloomberg terminal. That's coming up at 10 a.m. New York time. Coming up on this program right now, top Democratic donors are planning get-rich-quick ideas for Vice President Kamala Harris's campaign. In the focus of Wall Street Beat, we'll talk about Democratic fundraising. This is Bloomberg.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
This is Bloomberg Open Interest. Let's take a quick check on stocks right now because there is a lot of action in this market. The S&P 500 sinking right now, down more than 1%. The NASDAQ 100, I'm going to go ahead and call that a plunge. We are nearing a 2% intraday drawdown on your big tech index. Meanwhile, the small caps, your relative outperformer, they were earlier, as Matt Miller said, but now sinking a little bit in sympathy. You can see the Russell 2000 down about 0.3%, Shanali.
And we want to switch gears, talk about the Wall Street beat here. The Wall Street's top Democratic donors are on a mission that is raise a lot of money and fast. They have sprung into action to fill the campaign for Kamala Harris to help close the fundraising gap between her and her Republican opponent, Donald Trump. For more, we are joined by politics editor Laura Davison in Washington. And you think about the meeting that was called on, this big hitter meeting. You had Centerview's Blair Efron, Brad Karp of Paul Weiss, Mark Lazary, Ray McGuire of Lazard, and of course others invited like Cravath's Faiza Saeed, Roger Altman. What's to come of this? Is part of this, Laura, the worry here that not enough money will be raised fast enough given how much has already been spent?
Yes, that is the huge worry. Democrats right now are going into this fight with Kamala Harris with less money in the bank than Republicans, and they have little time to kind of organize and get going. They had, sort of the Biden network. That network had largely been tapped. There was a lot of malaise, particularly over the past month, as donors said, look, we're not going to give any more. But Democratic donors are realizing there's a moment right now that people are excited about Harris and want to give, and realizing they only have 3.5 months to raise more money. So they're looking at how can we get out there and do this quickly. So they're looking at things like, can we do Zoom calls? There's a Zoom call that the campaign actually just scheduled for a couple weeks from now that is from anywhere from $25 to over $6,000 to attend, because they realize they need to they don't have time. Harris both has to do her job as vice president and campaign, and they just can't get her physically to enough fundraisers in the next several weeks.
I saw a tweet from a venture capitalist, Matt Turk, Laura. He says Silicon Valley is pivoting from Trump to Harris even faster than it pivoted from crypto to AI. Is that true? Because of all the big names out of Silicon Valley that we've been talking about, Andreessen and Horowitz and Thiel and Musk, all of those names are giving to Republicans. So are we seeing Silicon Valley deliver for Kamala?
Yeah, the same efforts we're seeing on Wall Street, we're also seeing in Silicon Valley. They're having the same kind of conversations of how can we start to raise money. This is, all politics are at its core local, and Harris, represents California. She is from there. She has personal relationships with some of these people. So some of the folks who may not have been as inclined to give to Biden are now coming out of the woodwork to give to Harris.
All right, Laura Davison, you've been a busy woman tracking all of it from the politics to the money. We thank you for your reporting. And guys, it's really interesting. I mean, so much money is being raised, so much money has been spent. And it reminds me of the conversation that we were having with Mark Douglas of Mountain just a couple days ago, that is it being spent effectively, efficiently? Have you seen these ads for all the money that's being spent?
Have you?
Really,
I haven't seen any of these.
They haven't been very
ads.
visible.
I don't watch a whole lot of cable television outside of Bloomberg TV.
You're on cable television.
Maybe that's why I'm not watching it. But, it's interesting. I haven't seen much of the ads. But the interesting thing here is there was a divisiveness before heading into this moment. It's not like a lot of the people that are on the fence are now going to step around and donate big dollars. They don't know what they're all going to do yet. And the clock is ticking. That's the problem here.
All right, I haven't seen any, and I've been worried ever since Mark Douglas told us that, because I hate it when money's spent inefficiently.
Shouldn't they spend it on cable TV ads? I don't know.
Or put it on radio or have it on my socials, I guess Facebook had problems with that in the last election. Coming up in the next hour, Stephanie Guild, Robinhood Financial, head of investment strategy, joins us. She says the market is due for a near-term correction.
looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Connection lost.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio looking at some new home sales just crossing the tape a little bit weaker than expected. We'll break that down coming up with, we're going to do that with our good friend Drew Redding, Bloomberg Intelligence. He covers all the home building stocks. Steve Mann, he covers Tesla. Tesla stock down double digits here this morning on weaker than expected auto news there. Kim Forrest, Boca Capital Partners, she's going to give us her market call. And then Mandeep Singh is going to join us around out this hour and talk about the Alphabet earnings and talk about big tech. So we got a lot going on in this first hour of Bloomberg Intelligence. Let's kick it all off with our good friend, Mr. John Tucker.
And it is a tech-led slump. Probably no surprise there. Communication services, information technology helping lead losses in the S&P 500. This report being brought to you by Interactive Brokers. Discover the future of trading with their next-generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. Tesla among the worst performing stocks right now in the S&P 500. Its shares down over 12%. Profits slumping for a third quarter in a row. Not far behind Alphabet, those shares right now. The Google parent, those shares right now down 3.2%. And the Russell, that was up earlier. It is now lower. So much for the rotation. S&P 500, 73 points lower. That's down 1.3%. 5481 on the index. The NASDAQ 100 right now, 424 points lower. That is down 2.2%. The NASDAQ 100, 331 points lower. Greg Bowdle of BNP Paribas, he remains more bearish than most in this market.
Obviously, we've had massive outperformance from the large caps, the AI bellwethers. We've now had this squeeze higher in things like the banks and the small and mid caps. So what we're at risk of, if the data does slow more than most expect through Q3, Q4, is that you can get a more correlated sell-off.
Right now, treasuries are lower. The 2-year yield down close to 6 points, 6 basis points. Right now at 4.39. The 10-year yield 2 basis points lower. That's at 4.22. Look north, maybe for a taste of what's to come of the U.S. The Bank of Canada out with its key rate, a cut of 1/4 point. The Fed meets at the end of the month, and former New York Fed Chief Bill Dudley changing his tune. Now says, get on with it. He wants a rate cut at the July meeting. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul, Alex.
All right. Well, thank you so much, John Tucker. In the small cap defense, Russell's only down 0.5%. Take a look at the Nasdaq down 2% or the S&P up down over 1%. I'm just saying it's still relatively better. It's losing less. Just saying.
Losing less.
Losing less.
Okay,
yeah.
So the rotation theme is still there.
I feel like I need to defend a small cap a little bit there. All right, let's get back to those new home sales for June. So they are pretty much flat, but you had May revised lower, and it did miss estimates. So I'm trying to understand if this is a good number, a bad number, a status quo number. But luckily, I don't have to make that call. Drew Redding does. Bloomberg Intelligence U.S. home building analyst joins us now. Drew, what is your take on new home sales numbers?
Yeah, so the number was a little bit softer than expected, but keep in mind, during the month of June, you'll typically see a seasonal slowdown. It's not uncommon to see sales decline in the mid-single-digit range. But you have to remember, we've been talking for a while about how the new home market has been comparatively stronger than resales. But when you have interest rates above 7% for 3 months, we were above 7.5% in April, it does start to take a toll. And in addition to the impact on affordability, we're starting to see a decline in consumer confidence, and it's something that builders have cited as a hurdle to demand. At the same time, you have buyers taking more of a wait-and-see approach because you have much more knowledgeable buyers out there who know what the Fed is doing. Maybe they're waiting for prices to come down a little bit. Maybe they're waiting for rates to drop a little bit. So a couple factors at play here.
I don't know, I'm looking at the Mortgage Bankers Association 30-year contract rate. We're now at 6.82%, below 7. So my 6% mortgage, I'm still looking pretty good. I'm looking to refi, but Drew's giving me no love here on the interest rates. Neither is Ira Jersey. They're conspiring against me. So, Drew, when you talk to the builders out there, what do they say about their ability to buy down mortgages for their customers? Is that still an incentive that is being widely used, and is that impacting their profitability?
Yeah, that's still the number one thing out there in the market that's kind of getting people, to get them through the close. The hope was when we came into the year that with rates pulling back as they were earlier, that builders would be able to dial back their use of incentives, and we just haven't seen that. And in fact, we think they're going to remain elevated through the remainder of the year. Now, you did mention that rates came back in below 7%, which is certainly a positive indicator. And we heard from a couple of builders that as we've gotten into July with rates pulling back, we've seen a commensurate improvement in traffic. So we think that might help a little bit on the margins during the slower summer months.
And inventory, how's that going?
Yeah, great question. That's really the one everyone's paying attention to right now. In the new home market, you have inventories rising because builders have taken kind of a different approach to the business. They're building more spec homes, and the idea was let's have product that's available that we could close in 30 to 60 days and compete with the resale market. I think when you talk about inventory, what you really want to pay attention to is what's happening in the resale market. Compared to last year, we're up about 20%. So a pretty big jump. Now, keep in mind that's off a low base. If you look back to 2019, which is the last time we had a normal market, we're still down over 20%. I think more important is what we're seeing in some of the local markets out there. And the ones that have come to mind are Texas and Florida, where you're seeing resale inventories significantly higher than they were in 2019, which kind of throws a cog in the competitive environment and could start to put pressure on prices.
Hey, Drew, we appreciate it. Thank you very much. Way to break it down for us. Drew Redding, Bloomberg Intelligence, U.S. home building analyst. Not there yet for Paul's refi. All right, let's get back to the market here because you're looking at the Nasdaq off by 2 percentage points off the lows of the session, but it's brutal out there. And volume isn't terrible. It's actually ticking up a little bit. Norma Linda of Bloomberg joins us now for some of the movers that she's paying attention to. Individually, we got some really fun names to pay attention to, like Alphabet.
Yes, looking at Alphabet, I'm seeing shares falling for their worst day since the end of January. That's down as much as 5.5%. Now, this is after it's really been getting a bit of criticism about its CapEx spending. It's really been pouring a lot of money into its drive to outmatch its rivals on the AI front, and it seems to have forced a lot more spending than expected. Capital spending rose to $13.2 billion in the second quarter. That exceeded analyst estimates of $12.2. And this has also really been in focus. We've got analysts that are highlighting weakness in its YouTube sector, and that's really been weighing on the stock as well.
I don't know. I'm of the camp where this management team has earned its chance to spend as much money they want to spend it. I think they've earned that. So if they want to spend more on the cloud, go for it.
It's a really fair point. Versus
some management teams don't have that credibility. This one does.
Versus some might say that Elon Musk saying the total addressable market of robots is 8 billion because everyone's going to want one. Maybe they're different.
Right.
Maybe they're different.
Two different camps.
That brings us to the next story.
Yes. So let's just take a look at Tesla since we're already talking about it. I'm watching Tesla shares plunging as much as 13%. That's the biggest decline since also the end of January. And this is after Tesla reported another quarter of disappointing forecasts and postponed its highly anticipated unveiling of its autonomous taxis. So we know that it was initially supposed to be unveiling in August. It's since been pushed back to October. So they really are seeing a bit of pressure as they are really relying on this delayed robotaxi.
It was Bloomberg who reported
it
would be postponed. At the time, Elon Musk pushed back against that story. And now we see we were right.
Context.
We appreciate that. And then before you go, we talked about this yesterday when the news broke on the show, but LVMH really having a tough time. Sales across the board, whether you're looking at champagne or leather goods, all of that organic sales getting hit.
It's so interesting, especially as we look at the consumer, particularly on the high end. So we are seeing LVMH in Paris, it was down as much as 6.5%. That's the biggest loss that it saw intraday since October. We've got U.S. depository shares sliding as much as 1.2%. Now, this is all due to a slowdown in demand on high-end items. This is really interesting. I'm actually working on a story that's focused on high-end shoppers, particularly in the real estate market. We are seeing the highest share of all cash buyers in the luxury new home market. So it's interesting how you're seeing luxury buyers picking and choosing where they want to put their funds, and apparently it's not here for retail.
Interesting.
I just go to John Tucker to figure out how the luxury customer is faring, what they're spending money on.
And remember that LVMH is a partnership with Timberland. LVMH does not own Timberland.
I did buy a new pair of shoes, I should point out.
Did you?
Did you?
Do you have 3 now? He's actually took it off and showed it to us, for those of you who are on radio. So you have 3 pairs now.
They're like topsiders. I used to wear these in high school. The Sperry's.
Sperry's, love a good Sperry.
I guess it's not technically
Dan Ives
luxury.
was in earlier.
Oh man, that shirt was amazing.
You did not hold a candle to Dan Ives. He had some pink shoes sporting anyway, so it was a look, but very good. It fits. That topsiders fit with the John Tucker look.
Totally.
Totally in line.
That tracks. It's the same thing.
Perfect. Norma Linda, thank you so much for that. We appreciate it. Going back to that Tesla story, again, as Nora was just reporting, disappointing quarter, the stock's off 12%. Elon Musk trying to redirect the focus of investors on other parts of the company, AI, robotaxis, and the like. Steve Mann joins us. He covers the global auto industry for Bloomberg Intelligence. Steve, what'd you make of the quarter last night holistically for the Tesla story?
I mean, I still like their long-term, medium-term outlook on AI. I'm not, in our view, we're not including 8 billion Optimus robots. I think that's a little bit out there. But AI will continue to drive the stock. But I think today people are focused on their auto business. It's a little bit worrying. I think investors were expecting their automotive gross margin to flatten out in the second quarter versus the first, but it did decline about 150 basis points to 13.9%, which is in line with the legacy automakers' automotive gross margin of 14%. So there is some concerns with the investors. Are there any more upside on margin? Are they really that good with cost?
But I guess the question is, how do we value the stock? So I hear you that the auto part of their business is very much maybe in line with what other auto companies are talking about, but they trade an estimated PE of like 90 times. Like, is it worth it for that if it's also being valued as an AI company?
I think there's a couple of things that the investors are focused on beyond the second quarter. You know, they did pull ahead the start of production for a more affordable EV from like the second half of next year to the first half, which is critical. I think the market, the EV market today, globally is actually consumers in the EV market are actually looking for a more affordable EV, something that's, you know, less than $50,000 US. You know, most of the EVs offered today are above $50,000. So, you know, I think investors are hoping that, you know, into 2025 and into 2026, we're going to get a rebound in EV sales because there's going to be more affordable EVs, budget-friendly EVs for the mass market.
Steve, Tesla right now is an auto company, and it's an other company. Elon wants you to focus on the other. Can you define what's in that other bucket and when investors believe it will be material to their revenues and profits?
Yeah, you know, he talks about AI quite a bit, you know, robo-taxi, the Optimus robot. But if you think of AI, I think there's, you know, potentially even more ways to generate revenues from AI. One of the things that I think the market is also focused on, other than robo-taxi, taking a passenger from point A to point B, is, for example, you know, these cars have huge battery storage capacity, right? And these things, if they can move about on its own, you can really help out the utilities in terms of, you know, redistributing power across the grid.
Well, to that point, I mean, their energy business was actually quite impressive. It had its highest installation of batteries in revenue ever, and energy accounted for just 12% and 16% of Tesla's revenue and gross profit, respectively. I mean, yeah, it's going to fluctuate, but that's pretty strong.
Yeah, it's a good sign. I think you know, those tend to be a little bit lumpy because the orders are big, and so whenever they deliver the order and whenever they book it, that tends to be lumpy. I think we'll have to see if it's going to be consistent. But I think the investors are very focused on the auto business. You know, when are they going to roll out the new? Are they going to be on time in rolling out the new EV, the affordable EV? And then longer term, it's really, you know, AI. Is he going to deliver? What is he going to say in October? You know, the AI event that he's hosting. You know, there were a lot of questions about that during the call, but they were pretty tight-lipped.
So, what is that October event? Can you tell us what the company says it is and what you think it may be?
Ooh, good distinction.
Yeah. Yeah. I think for the most part, it's going to be, you know, what is this new vehicle they're launching? I think investors will be focused on what is this new vehicle? What is the price of this vehicle? How are you going to manufacture it so it further cuts, you know, per unit costs? The other one is the full self-driving system that they're trying to roll out, the robo-taxi that they're trying to roll out. I think people are going to be focused on when is that going to generate, you know, material earnings and material revenue. Now, I think it's not going to be until 2030, but I really think the other thing that's going to get people really excited is the Optimus robot, because the Optimus robot, they really haven't talked too much about it yet. I don't think it's going to get to 8 billion unit sales anytime soon. But, you know, if they can incorporate those Optimus robot into their manufacturing, I think there's going to be a lot of potential for cost cuts.
Okay, so the addressable market isn't John Tucker buying one. The addressable market is Musk using them to build a car.
That's right.
Oh, okay. So don't worry, John Tucker. You're not.
Well, no, I'm disappointed
interested?
now.
Oh, bummer.
I was going to have it do everything for me.
To this point, like, if John Tucker wanted one, could eventually he actually buy one?
No, I don't think so. He doesn't. It's not for sale right now. I think what he's going to try to do is, you know, build this robot, optimize this robot, you know, within the confines of Tesla first. You know, they're going to make it good enough, then they're going to offer it to the public.
All right, so
But
maybe
again,
just not yet.
that's going to be not soon. That's
Right,
not
yeah,
gonna
yeah.
be soon.
So you gotta wait.
Yeah.
You gotta wait, John
Yes.
Tucker. All right, Steve, thanks a lot. Really appreciate it. Steve Mann, Bloomberg Intelligence, Global Autos and Industrials Research Analyst. You have to wonder, just people on the call being like, really? Addressable market is everyone on the planet?
Yep.
Like, I don't know. That
Well,
seems
just
a little
look at
bit
the
pie in the
stock.
sky.
I mean, from starting the year till like the third week of April, the stock was down 50%. Since then, up 75%. So, I mean, it's just, do you buy off on all these other bets outside of the car business where you have to bet metal, or don't you? And that's
yeah.
kind of,
And then how do you
But that's
value
always
that?
been the case
It's
for
true.
Tesla story. You have to believe in Elon. That's simple as that.
But it's going even bigger and bigger. It's like the other gets bigger and bigger with
Yes.
more stuff. Anyway, we're going to talk more about this market here. Kim Forrest, a founder and CIO over at Boca Capital Partners, will be joining us on the sell-off we're seeing in the market with the NASDAQ off now by 2 percentage points. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The tech-heavy NASDAQ 100 plumbing the session lows. Right now down over 2%. And, of course, you can blame the earnings. Tesla, worst performer in the index. Tesla shares right now, they are down 11.4%. Alphabet, that is down 3.3% after the Google parent sunk more resources into the drive to outmatch their rivals in artificial intelligence. So where's the money going? Treasury 2-year yields, they are tumbling right now, down just about 6 basis points, 438 on the 2-year. The 10-year yield, 2 basis points lower. That is at 422. Also, it's worth mentioning the Japanese yen. Remember that was hovering around 160. There was intervention. It has strengthened. It now takes 153 yen to buy $1. So that is a stronger yen. And the loonie, the Canadian currency, steady after the Bank of Canada decided to cut rates by 25 basis points. That was expected. Mortgage Bankers Association reporting loan rates dipping. The average rate on a 30-year fixed mortgage dropping last week to 6.82%. That is actually the lowest since February. S&P 500, 79 points lower. That is down 1.4%. We've breached 5,500, 54.76 on the index. The Dow Jones Industrial is below 40,000, down 359 points. And the NASDAQ 100, 427 points lower. That is down just about 2.2%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. This is Bloomberg Intelligence Radio. Happy Wednesday, everybody. Happy Hump Day. I'm Alex Steele alongside Paul Sweeney and John Tucker. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. So John Tucker laid out the market decline perfectly. And my really silly question is, well, why are stocks down? And I say silly because you can say, oh, of course, Google, Tesla, they disappointed, therefore stocks are down. Is that it? Or is it a continuation of last week and the rotation theme is still intact? Is there something else going on here? Bill Dudley talking in a Bloomberg opinion article about how he changed his mind. He thinks that a cut should come in July because employment doesn't look that good. So let's get the read here with Kim Forrest, founder and chief investment officer at Boca Capital Partners, joining us from Pittsburgh. Kim, it's a dumb question. Why are stocks down so much?
Okay, I'm gonna answer it with a dumb answer. Are you ready?
Yeah.
Because there's more sellers than buyers.
No, I love this answer, actually.
I know. Well, I learned this on my very first day at Parker Hunter when I was a sell-side analyst. That's how one of the radio announcers would say, Parker Hunter. Anyhow, yes. And they didn't cover this in an MBA program on valuation, but when people get afraid that maybe they've paid too much for a stock or maybe that things aren't going the way they think, they sell. And selling makes stocks go down because when there's more sellers than buyers, the prices fall. And that is why we love markets, because it does the inverse. When there are more buyers than sellers, prices go up. But the fundamentals really are, is everything okay? And it looks like some things are okay and some things aren't. And it depends on what day the market thinks more of one than the other.
What do you make of this whole AI trade in the marketplace? Certainly was a theme, not just for tech companies, but for the whole market beginning in 2023. How do you view it? Because, again, we've had Tesla talking about it last night, Google talking about it still.
Well, I have a nuanced view because I was a software developer in companies that actually developed neural networks and then used neural networks. So, and that is the underlying technology that's behind ChatGPT and autonomous driving and all of that kind of stuff. So here's the skinny on that. I strongly believe the moment for AI is finally here because computers can be fast enough and we have enough of the right data to be able to train models. But investors are always impatient with new technology. And they thought, just like they thought autonomous cars were just around the corner in 2016, they're not. It always takes longer to develop really good technology. AI is really good, but it's not going to pay off in the next 15 to 20 minutes. So investors are becoming aware of that right now, especially as Google kind of outlined its spending plans that go on for the foreseeable future.
Well, that's where I think that question then goes to my first question of why stocks are selling off, and that basically they have to spend to then monetize, and there's going to be a gap between the spending and the monetization, and there's still a race to spend. And as an investor, how do you value something like that?
Well, in my mind, you don't yet, right? I don't know what Google is going to be able to monetize because we're not clear what problem they're solving. Like, that's the first thing we have to ask. What problem are you solving? Is it worth solving with technology, and how much money will you get? And we don't have any of those answers. But we do have this idea that AI is going to work out. So how we play this is we've been buying the semis and then storage companies or semis that have to do with storage, because we know AI takes tons of data, unbelievable amounts of data, probably more data than it takes electricity. I mean, I can't emphasize how much data is needed. Okay, I think I've overdone that. But that's what we've been doing. So we buy companies like NetApp, which makes storage, enterprise storage devices, and then Micron, because they make one of the elements of storage, which is called NAND. It's a technology, a chip that you can store things on. And that is how we've played it, because we don't know what time frame we're going to be in. We just know somewhere within the next 10 years, AI is going to be a thing and show productivity, and people will pay for it.
Outside of technology, Kim, are there areas that are interest you?
Oh, all of them are interesting, honestly. You know, energy is a big question mark because it's been kind of unloved as we've done the move towards green, and now we're kind of going, maybe we need, you know, energy for a while longer, you know, the old-fashioned kind that we dig out of the earth. That's kind of interesting. And I think if we're going to be in a declining interest rate environment, maybe things like housing, and then ancillary areas around housing like home goods and that sort of thing, you know, items that people buy when they buy a new house, that might be interesting. And again, these are kind of 3 to 5 year time periods for us. We don't ever really want to make bets on the next 6 months because anything can happen.
Right.
So
which
we're
kind
always looking out 3 to 5 years.
Which brings me, though, to the election, Kim, because I appreciate that you're not going to trade around the election, but there are some policies that feel binary, and election and energy may be one of them in a Trump versus Harris world, which would then affect investment and returns and prices in the next, say, 3 to 5 years, which is your time frame. How do you wind up thinking about it?
Sure. Well, I'm kind of a realist too. As much as you would like the world to be driven by renewables, it's not practical. It just isn't. If you look at any of the numbers, even as the use of renewables have gone up, so too has the use of non-renewables, right? So I think if you know, sure, the scale may be tilted towards renewables. Maybe you play it by finding a company that does both. And a lot of the energy companies are trying to get a green footprint somehow. So I think that might be where you look.
Fixed income, Kim, how are you guys allocating to fixed income these days? Because, you know, folks can sit into your treasury and get darn near, 4.4%.
I know. Well, we're still in the short term, right? Like, whenever I have to replace a bond, I'm trying to go as short as I can to get the highest amount. And 2 to 3 years is where we're liking to buy. Anything longer than that, I don't know. It just seems too risky because it could go literally either way now, right? If we're going to reinflate, if the curve is going to go back to normal, maybe long-term rates will go up a bit, short-term rates will fall. So let's live it up and buy some short-term rates, because we don't trade them. We just let them expire, right? So we're buying the yield.
So
to maturity.
Before we let you go, let's get into the debate about small caps. Do you say yay or nay to small caps?
I am a big yay.
Okay.
I have about half of my portfolios in small, I would say mid cap. I can't really look at anybody less than $1 billion. I don't have the temperament for the companies that live there. That being said, those high quality small companies often get bought by larger companies. And that's kind of what we're looking for, is companies that have a really great track record of making products that their clients love. And a lot of them tend to get bought out, and it really does add a boost to your returns. So that's what we look for.
All right, good stuff. Kim, we appreciate you. Thank you very much. Kim Forrest, founder and CIO of Boca Capital Partners, joining us on that. Okay, yeah or nay, but it's interesting. It's an M&A play. It's not like a Fed cutting play.
Right.
It's not necessarily a rotation play, but a takeout play. So that's also quite interesting. Hey, just to check in here, because we like this because it's oil. Oil inventory numbers are out, and there was a pretty solid draw, about 3.7 million barrel draw. And remember that oil has just been really beaten up over the last week and a half, so that definitely was something. Especially because refinery utilization was down 2%. So they're not really working. Yeah, crude inventories are drawing at the same time. So that should be bullish.
Yeah, we spoke with Julian Lee, Bloomberg News energy economist, I guess, or kind of oil person. He's got I love talking to him because he's got incredible experience working with the Saudis and so on and so forth. So we were just talking about global oil in here. And he says, it is a little bit surprising that it fell below 80 on WTI crude oil, but he was kind of suggesting it's a demand story.
Yeah. I also feel like he's a professor at Hogwarts in another life, but that's a different story. All right, Mandeep Singh is up next to talk more about Google earnings. For now, we go to Michael Barr with World and National News.
Thank you very much, Alex. Paul, John. Vice President Kamala Harris returns to the campaign trail today. Harris will speak in Indianapolis. Along with the delegates, Harris's presidential campaign is moving quickly to lock up donors. We get that part of the story from Bloomberg's Nathan Hager in Washington.
About 40 Democratic donors in law and finance are meeting virtually today to start hammering out economic talking points to sell a Harris agenda to Wall Street. A source tells Bloomberg News the hosts of this event include Blair Efron of Centerview Partners, Mark Lasry of Avenue Capital, and Lazard's Ray McGuire. Democrats lost nearly a month of fundraising time after President Biden's disastrous debate performance, but in the 24 hours after he dropped out of the race, the Harris campaign raised a record $100 million, and she stands to inherit the president's $96 million war chest. In Washington, I'm Nathan Hager, Bloomberg Radio.
Former President Trump is also back on the campaign trail, holding a rally today in Charlotte, North Carolina. One notable change, though, that we will see, today's rally in North Carolina will be held indoors, a stark difference from that rally in Butler, Pennsylvania, where a gunman tried to assassinate the former president. Trump campaign officials are heeding the warnings from the Secret Service about those outdoor rallies. Israel's prime minister will address a joint session of Congress later today. Benjamin Netanyahu will do it for the fourth time, but Netanyahu faces a storm of protests over the Gaza war, and one critic says that he has killed far too many civilians. It's called a hydrothermal explosion when underground water suddenly turns to steam. That's what happened at Yellowstone National Park. A geyser in the area known as Biscuit Basin exploded, and tourists were sent scrambling. No one was injured. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg.
hits, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash drops for big tech, dragging the stock indexes lower after profit reports for Tesla and Alphabet. They disappointed. AT&T, that's actually a bright spot today. They're up about 3.3%. Profit for the latest quarter did match expectations. But Visa losing about 3.5%. Revenue for the latest quarter coming up just short of analyst expectations. Russell 2000 index, the smaller stocks, that jumped at least 1% in 7 of the last 10 days. Down today, but far less than the other major indexes. And Julian Emanuel at Evercore ISI is betting a rotation to small companies. That's going to continue.
The drama of July's outperformance in small caps is really almost breathtaking. Obviously, the first couple of weeks was sort of to the good, and as the market has begun what we think is a broader correction at last week's high, you're still seeing that outperformance to the downside. But the thought is outperformance, and it's there, and we think it's durable.
133 companies in the S&P 500 reporting earnings so far. Of those, 79% have delivered positive earnings surprises. S&P 500, 83 points lower, down 1.5%. Dow Jones Industrial Average down 370 points. The NASDAQ 100, 464 points lower. That is down 2.3%. Two-year yield down 6 basis points. Right now at 439. The 10, 2 basis points lower, 422 there. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. Alex Deal here alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in business, finance, economics, and earnings through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. And now is our great time. We get to focus on Google, a.k.a. Alphabet. That stock falling the most since February 26th and hitting its lowest level since June 18th. This is really hitting it, the earnings from yesterday. So Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst, is joining us now in studio to dissect it. So on the one hand, we have the CapEx spend, and the other hand, we have the YouTube stuff. Which is the bigger driver of the downside today?
CapEx. I mean, simply because this quarter, companies are not getting a pass on boosting CapEx. That wasn't the case last quarter, but clearly, I think investors are wary about how much CapEx these companies are going to throw on AI. And look, in the case of Alphabet, there is revenue in the cloud segment, so they quantified the AI impact on cloud, which was high single-digit contribution to cloud segment, and cloud segment actually saw an acceleration in top-line growth. But YouTube miss, I think I attribute that more to softer spending outside of financial services and retail, like sectors like automotive. They're not spending on digital ads right now because the sector is going through a cyclical downturn. So there is that cyclical element to YouTube's business, but I think there are a lot of positives. Core search growing at 14%. I mean, think about the scale of search and the fact that they are able to grow double digits. That's quite impressive, and that too at a very healthy margin. I mean, the biggest fear for this company was margins are going to get degraded because of AI and whatnot. That we haven't seen that. So a lot of positives, but clearly CapEx was an overhang.
All right, I've been making a point today. If any team deserves the benefit of the doubt of higher CapEx, it's Sundar Pichai and all the folks at Google. Let's stop whining about CapEx. Have they ever not generated a return on their spending?
I mean, the problem with Google's management team is they say very little on the earnings call. Like, even when you answer them, ask a question, they would answer it with as little words as possible. So, it sounded like they are bullish on their AI opportunity, and it's actually monetizing. Some of that CapEx is going towards Waymo. If you think about, robo-taxis and what Tesla had to go through their call last night, Waymo actually did 2 million rides year to date. And these are all autonomous rides, and they're expanding to other cities. So think about, the scale in that business if they're able to do actually autonomous driving successfully. So I do think their CapEx is well spent, but they just don't explain it that well to the street, to get the credit.
So when it comes to then the AI spend, what other companies are going to get judged in the same harsh light, and what's Google's one-up on them, if any?
Meta. I mean, you saw a negative reaction with Alphabet. Yeah. I mean, think about what will happen.
Meta's going to be worse?
Meta is going to be worse. Even last quarter when they raised their CapEx, Meta had a negative stock reaction simply because investors are concerned about how much this company is going to spend on metaverse versus AI. And so in the case of Meta, they're losing $18 billion a year on Reality Labs. They're spending CapEx in addition to the AI CapEx, which they launched a new large language model. And to my mind, any company right now with their own large language model, whether it's Alphabet, Meta, or Microsoft OpenAI, they have an advantage. They have the best reasoning capability when it comes to the AI spend, and it's actually a future driver of revenue. So it all comes down to how they are going to monetize it. And I think with Microsoft and Google, they have an advantage because it shows up in the cloud revenue. In the case of Meta, they have to monetize the AI spend through ad revenue or a subscription-based chatbot offering, which nobody knows when that will come.
What is Gemini? And should John Tucker and I be using it?
Well, it's a better way to search for certain type of queries. So whenever you want, something with a detailed answer as opposed to going through 10 blue links to find that answer, Gemini is great. The one good thing about Gemini is when you search for a query, it's going to show you the relevant YouTube link. Whereas if you search that on ChatGPT or Claude, it's not going to have that YouTube link. So it's going to generate the text, it's going to generate a summary, it's going to answer your query, but it won't have that appropriate YouTube link. And that's Google's biggest advantage with the large language models.
Do I have to pay for that?
Yeah, it's a $20 subscription for the advanced version.
That ain't happening.
But some people will. I think that's kind of...
And that's where, I mean, you are not... you don't think it's a big deal, but I think Google owning Maps and YouTube is such a big deal in this arena of large language models because it's one thing to generate a text-based response. It's another thing to have a blue link with the YouTube video that they want you to see or the map link that they want you to click on inside that response. And other large language models can't do it because they don't own these assets. So,
well, before I let you go, one thing though, but the Meta is that if these companies though don't spend, then at some point when all this is monetizable in a big way, all of a sudden everyone's going to complain that then Meta's super far behind. So, what's the chicken and the egg here?
I mean, I still think nobody wants to be the first one to pull back on CapEx. So it really is a question of when do we have sufficient supply of GPUs? And because the market is supply constrained when it comes to the chip side of the equation, nobody wants to come across and say, oh, I have enough and I don't need to spend on CapEx anymore. And I think right now these companies generate so much cash every year. Like Alphabet will generate over $100 billion in free cash flow. So they can afford to spend $60 billion in CapEx. And they're looking to make a $23 billion acquisition that fell through. But clearly, they want to spend their free cash flow.
Which to your point,
Yeah, go ahead.
You earned it.
Yep.
Spend it.
Yep.
All right, Mandeep, you're the best. So helpful, so great. I asked him if he slept. He said yes, but I don't know if that's entirely true.
Kids at home too to make it even worse.
I know. But he was on late yesterday, early
handle
today, and all that stuff. All right, Mandeep, the best. Mandeep Singh, Bloomberg Intelligence, senior tech industry analyst. It's like I feel like investors want both. Like they want the growth and they want the company to be profitable with it, but then they don't want the CapEx spend. It's like, dude, you can't have both.
Yeah, but then you got analysts like Dan Ives who just says, you pick the management teams, you pick the technology, and you just go. And you just got to shut your eyes and, not worry about the peaks and valleys. And you think about Tesla, again, first quarter through the third week of April, down 50%. only to bounce back 75%. So you got to be ready for those roller coasters with these tech names, I guess.
Yeah, but then the problem with Tesla is that at least like I feel like it's clearly laid out if you're listening to like a Google conference call. The problem with Tesla is like when he says something about a robo-taxi and Elon Musk says our solution would work anywhere, even a new Earth. Like what? Like I don't understand. Like they're all these. It's Elon Musky stuff, and that must be very difficult.
There is that Elon Musk risk
stuff
that you take.
Or Musky stuff, as I am saying it. All right, much more coming up. This is Bloomberg Intelligence on Bloomberg Radio.
Company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom. We'll look at some of the company stories we're following. This is a story, interesting one, well written from Women's Wear Daily. Victoria's Secret bringing back its fashion show and aiming to be bigger and more inclusive than ever before. The exact date and location of the fashion show, they haven't been revealed yet. The show producers, who are women, and longtime Victoria's Secret executives, optimistic this version is going to be something viewers have never seen before. The last Victoria's Secret show, which took place in 2018, featured the Victoria's Secret Angels. At the time, Victoria's Secret, it was part of the L Brands, and then you had that 2020 expose in the New York Times alleging a culture of misogyny, bullying, and harassment. The brand's annual TV special was then canceled in 2019. Starbucks, world's biggest coffee house chain, generally locks in prices for green coffee 9 to 18 months in advance, so it can usually weather any price volatility for a while, but it's not the case for the small shops. Global coffee drinkers who hope the price of their daily fix would soon stop rising, they are due for a bitter wake-up call. This is about to get even worse. Both the high-end Arabica beans, favored by coffee chains like Starbucks, and the more budget-friendly Robusto variety, that's like used in instant coffees, they have spiked in prices. And this is company news. According to the New York Post, it was the worst case scenario on the roads, WURST. One of Oscar Mayer's famous hot dog-shaped Wienermobiles crashed and rolled over on a suburban Chicago highway. Fortunately, nobody was hurt. The Wienermobile flipped over. Bad news. That's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, everybody. Happy Hump Day. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance right here from our Midtown Manhattan headquarters studio. We also bring you up-to-date world and national news with Michael Barr. Michael?
Thank you very much, Alex. Paul, John, FBI Director Christopher Wray testifying today before a House committee on the assassination attempt against former President Trump.
As I've said from the beginning, the attempted assassination of the former president was an attack on our democracy and our democratic process, and we will not and do not tolerate political violence of any kind, especially a despicable account of this magnitude.
Wray's testimony comes a day after Kimberly Cheadle resigned as chief of the U.S. Secret Service. Meanwhile, the police body cam video of the officers investigating the attempt on Donald Trump's life is now public. The video shows officers and Secret Service agents on the roof of the building approaching the body of the shooter, Thomas Matthew Crooks. President Biden will address the nation tonight about his withdrawal from the 2024 race. Bloomberg will carry it live at 8 p.m. Today, Vice President Kamala Harris will campaign in Indianapolis. Meanwhile, Donald Trump is holding his first public campaign rally since Biden dropped out. He will be in North Carolina today. Anti-scale fences are up at the U.S. Capitol ahead of Israeli Prime Minister Benjamin Netanyahu's address to a joint meeting of Congress. Bloomberg's Amy Morris has a preview.
As Netanyahu arrived in Washington, he indicated that conditions for a ceasefire and hostage deal with Hamas are, quote, becoming ripe, suggesting the two sides are getting closer to agreeing to at least a temporary halt to their war in Gaza. While he is addressing Congress, he'll attempt to shore up U.S. support for Israel. However, many Democratic lawmakers have indicated they will not attend. Protesters are also expected in and around the Capitol. Netanyahu is scheduled to meet with President Biden on Thursday and then will meet with former President Trump in Florida on Friday. In Washington, Amy Morris, Bloomberg Radio.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Alex, Paul, John.
All right. Thanks so much, Michael Barr. So remember the outage thing that happened on Friday, and you know, planes were delayed. Mike McKee took 3 days to get home. Flights are still sort of disrupted this week for Delta. Well, we now maybe know how much it's going to cost. So apparently, Delta could take as much as a $500 million hit as the turmoil now begins to ease. And this comes from Citigroup. Cut estimates for Delta's third quarter earnings, adjusted earnings by 60 cents a share in a new report, citing, quote, operational expenses and potential customer compensation costs. The analyst, Stephen Trent, also cut two profit metrics by about $500 million each.
I'm still not clear as to why it was specific to Delta. Was it software that only they used to match their pilots with the equipment and their staff with the equipment?
I don't think it was just Delta. I think Delta just got hit the worst because of maybe how they use the software or what the software was for the company.
Yeah, it's just not a good look. And people talk about the lingering, reputational risk. But if you're in a Delta market, you're in a Delta market, and you're booking Delta. I can't think of a scenario where I wouldn't fly United, because that's 90% of my Newark traffic.
Yeah.
So, I don't know.
Well, here's the thing, is that Melius Research also said that they're looking at a $350 million impact to operating profit for Delta, plus a likely fine from the Department of Transportation, which is investigating Delta's treatment of passengers, although Mike McKee had raving reviews.
He did. Now, that should be used like in any kind of suit. You just get a clip of the audio of Michael McKee.
Yeah, totally. But I also...
Michael McKee generally calls him as he sees him.
Yeah.
Yeah, if somebody does something bad, he'll call it out.
He doesn't mince words. But I'm interested in, so say Delta pays a boatload of money, then they're going to want to recoup that cost. So do they sue Microsoft? Do they sue CrowdStrike? Like, how do you then own CrowdStrike when you don't really know what the legal challenge is and what the payment is going to be?
I mean, do they learn anything from this? Is anything going to change?
Apparently, CrowdStrike is having new barriers put up to make sure that the bug doesn't get passed through. So maybe?
I don't know. But again,
Brutal.
if you're flying out of Atlanta, you're flying Delta.
Oh, yeah. If I'm flying out of New York, I'm flying Delta. You're United, I'm Delta. Anyway, much more coming up in the next hour of Bloomberg Intelligence. We have Max Abelson on, a Bloomberg News finance reporter. He's talking about Wall Street donors and how they're handling a potential President Harris. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this half hour, fascinating discussion on commercial real estate. Abigail Doolittle is going to join us, along with Sonny Kelsey, Co-Chief Executive Officer, BGO. Is it time to go out there for some of these institutional investors and start buying commercial real estate? If we hit bottom there, it's going to be a fascinating discussion. We're checking with Anurag Rana, Bloomberg Intelligence technology analyst, talk about the tech stories of the day, Google and whatnot, and what to look forward to from some of the other big tech names, including Microsoft when they report earnings later. But right now, let's kick everything off with Mr. John Tucker and a Bloomberg Business Flash.
And the first batch of the results from the so-called Magnificent Seven group of tech stocks disappointing investors. Tesla, of course, falling short of second quarter profit estimates. Tesla shares right now, biggest drag in the S&P 500, 11.5% lower right now. And then you have Google parent Alphabet seeing weakness in the YouTube advertising revenue, among other things. Monica DeCenzo at JP Morgan Chase advising clients to actually buy these dips in the S&P 500 and elsewhere.
It does feel fairly to fully valued. And so the struggle now is you see the market down a couple percent, maybe do you jump in and buy? I think you probably see more volatility heading into the fall and into elections. And so I would use any pullback of 3-4% or more to start legging in.
S&P 500 right now down 1.5%, 83 points lower, 54.72 on the index. We've broken through 5,500 mark. The Dow Jones Industrial Average down 337 points. NASDAQ 100 down 476 points. That is a decline of 2.4%. The least worst, the smaller caps, Russell 2000 down just 0.25%. About a fifth of the S&P 500 firms have reported results so far this earnings season. Then you have both IBM and Chipotle Mexican Grill. They're going to post results. That comes after the close of regular trading today. Two-year yield almost 8 basis points lower at 437 right now. The 10, 4 basis points lower. That is at 420. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. Yeah, that's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. Let's also get some more details on some of the stocks that are moving, because it's earnings and there's a lot coming out. Norma Lindo of Bloomberg News back with us. All right, AT&T, you're watching that company. Now, Verizon missed because Paul Sweeney didn't buy a new phone.
Exactly.
and that was an equipment issue.
Culprit.
Yeah. What about AT&T?
Well, I mean, we are in the red across the board, but I've got one here for you in the green. As we're looking at AT&T, its shares are seeing their biggest gain since October of last year, up as much as 4.8%. Now, this is after it added far more mobile subscribers than Wall Street had expected in the second quarter. Fewer customers are canceling, and many have added wireless service to their broadband plans. It reported a 419,000 new monthly phone subscribers, according to a report that came out yesterday. So this is marking the first year-over-year increase in 8 quarters. So really good news here for AT&T, and we are seeing investors rallying behind it.
What else are you looking at? Google, we can't forget that.
Can't forget that. I know you all will be talking about it a bit later in this hour. We're looking at Alphabet shares falling after Google poured a lot of its resources into driving and outmatching its rivals in the AI space. It ended up spending much more money than expected. Capital spending rose to $13.2 billion in the second quarter, which was above analyst expectations of 12.2. We are seeing Alphabet shares falling, shedding as much as 4% for the lowest intraday level since July.
How about Visa? I know they missed estimates, but stock's down like 4% here.
And it's also rare for them to miss like that, no?
Yeah, I mean, I think that this is a really interesting one here because this is after its revenue the payment giant really did miss expectations. As you mentioned, we have shares down pretty substantially. And this is after a big quarterly revenue miss that fell short of Wall Street's expectations. It did see net revenue for the third quarter at $8.9 billion, which was short of analyst expectations here.
All right, well, it's not because of me. I'm spending, so I don't know what's going on.
You're there. You're loyal.
I'm there.
And you're a Visa guy.
Yeah, well, no, I go either way.
Oh, see, that's the thing.
Yeah.
Okay.
I'm an Amex person.
Likewise.
See, I don't do Amex that much. I have it in the wallet, but I just don't use it.
It's just
that
for
much.
the points, for the Delta points.
I have the Delta collab. Yeah, I have the Delta collab. Just got
But
some
I'm
great
old
points
school,
there.
green card, baby.
Okay.
They keep trying to offer me all these things. I'm like, no. I got this is what made me. This is what I'm going to stick with it. It's like Budweiser in cans. Norma, Linda, thanks so much. We appreciate that. All right, folks. Inflation is at the heart of economic issues this election cycle. Prices, they're starting to cool, but voters' perceptions still run hot. Wall Street Week's David Weston asked former Treasury Secretary Larry Sumner what we know so far about Vice President Harris's economic policies. Let's listen in.
We don't know much yet. The campaign's only been going for 2 days. But I think we've got some strong bases for optimism. First, it's been the Biden-Harris administration. And if you step back, it really has a remarkable record. I don't think any administration has so outperformed the economic forecasts on the day that it came into office as the Biden-Harris administration has. And that's because of an approach that is about investing in America and investing in America's future. And if you look at some of the things Vice President Harris has done, they have that orientation to the future. She knows that our children are our future, and that's why the child care credit and investing in children, investments that reduced the child poverty rate by a half when they were in effect, were so important to her. She knows that fiscal responsibility is central, and that's why she puts emphasis on the fact that we need to raise taxes where it is replacing the ineffective, massive corporate tax cuts that President Trump put into place. She understands that much of our future lies in exporting to the rest of the world. It's not her approach to call Africa and El Salvador countries, as President Trump did. It's her approach to work to strongly support their development, because she knows that more prosperous countries around the world make for a more prosperous United States. She knows that there's a strong role for the market system, that we need businesses to succeed if we're going to create jobs in the United States. She knows that actually better than J.D. Vance did, judging by his comments at the Republican convention. But she also knows that we need strong policies, strong regulatory policies if consumers are going to be protected, strong environmental policies if we're going to protect the planet. Look, she is focused on the future, and our future lies in technology that empowers and strengthens workers and that works for American children. And that's going to be, I believe, the focus of her administration. And it's a new generational approach and a stark contrast with what came before with Donald Trump and judging by what he's saying on the campaign trail, a even larger contrast with what would come if he were elected. What he describes, David, is a prescription for massive inflation. Ignore the deficit, bash the Fed, trash the dollar, cut back on labor supply by trying immediately to send millions of people home, stop subsidizing clean energy, and put massive tariffs on so businesses can't get cheap inputs. It's hard to imagine a better strategy for creating inflation, for creating high interest rates than the Trump strategy. President Harris, I believe, will avoid all those pro-inflation mistakes, and much more important, will build a future-oriented economy through our kids, through our technologies, through containing our debts, and through working with the world.
You've been listening to Larry Summers, former Treasury Secretary, talking to Wall Street Week's David Weston about Vice President Harris's economic policies as she tries to ascend to the presidency in November. Let's get more now on the money behind this race. Max Abelson joins us, Bloomberg News finance reporter, on an article about the get-rich-quick ideas. I was going to call them schemes, but they're not ideas. They're not schemes. They're ideas from Wall Street donors. They need to raise money fast for Vice President Harris.
Well, first of all, I have to give a shout out to the journalist who's really responsible for this work, who's Amanda Gordon, my friend and colleague, who's been reporting on the rich people who love Donald Trump, the former president, and the rich people who want to make Kamala Harris the next president. And, you know, listen, I don't want to give the wrong idea. I mean, wealthy Democratic donors on Wall Street have been, putting a lot of money, were putting a lot of money into the effort to reelect Biden. It's not as if they had closed their purses and their wallets, and then all of a sudden they're opening it up. But I think what Amanda's journalism highlights in a really vivid way is that they are going strong and they're going hard and they don't have a lot of time to raise this money. And when I say they, I want to be clear that we're talking about essentially the creme de la creme of Democratic donors. You've got, do you all know the name Blair Efron?
Sure. Yeah.
Yep, Centerview. I mean, you got Brad Karp. Brad Karp is technically a lawyer, but I think there's a part of big law that's essentially an extension of Wall Street. You've got Mark Lazary, Ray McGuire, wrote a profile of for Business Week back when he was running for mayor, if you all remember that. It's funny at Blackstone, obviously the most important donor inside Blackstone is Steve Schwartzman, who's giving a lot of money to Republicans. But don't forget, Blackstone's John Gray is there to, I don't know if he's essentially probably, I'm assuming not wealthy enough to counterbalance Schwartzman, but still a lot of money. The list goes on. Peter Orszag, Roger Altman. These are the people who've been at the highest levels of Wall Street's kind of Democratic caucus for a long time. And you just sense a lot of excitement about Harris, and they're going to be spending a lot of money.
It's interesting because I think Wall Street and just business in general is trying to get a sense of these early days. What would a Harris presidency mean for business? Would it be good for business? And I see Amanda quotes Jim Cramer in here telling investors on CNBC Wednesday that a Harris win would, quote, absolutely, no doubt about it, end quote, be good for U.S. businesses.
Only Jim Cramer would say no doubt about it, when, of course, no one ever knows what the future holds. But, speaking of business, I think it's important to pause and to remind our listeners that, Donald Trump, we know what Donald Trump will do for the business community, and let's talk about it. I mean, the big news is that he likes low taxes, and I mean low corporate taxes, and then low taxes on wealthy people. He also has pledged to deregulate, and he has shown that he wants to. That's why you have real enthusiasm for him on Wall Street. Howard Lutnick, John Paulson, Woody Johnson, John Katsimatidis. There are really, really deep wells of really rich Wall Street executives who want this guy to win. Omid Malik, they've been raising money for him. They're going to be raising money for him. I don't want listeners to think that when Wall Street looks at the 2024 presidential election, all of their money is going to Democrats, because that is not the case.
Oh, yeah.
But I think that there is a really big part of Wall Street that looks at Kamala Harris with a kind of optimism, with a kind of optimism that she gets them, that she understands them. I don't think they look at her the way that they would look at Bernie Sanders or Elizabeth Warren as a sort of, this is a loaded word, but as a kind of enemy. I think they look at her, maybe the right way to say this is, as a potential ally.
Well, I mean, Bloomberg's been reporting that the Harris campaign pulled in $100 million just from the announcement through Monday evening. And presumably that's from smaller donations as opposed to pulling in some of these Wall Street.
It is from smaller donations.
Well, I was going to say to that point that it also is from new donors, not just smaller, but new, which also raises the question that she would be the first woman and the first Indian American to be elected president. Obviously, President Obama was African American, so she would not be the first African American. And the idea is that hope going to bring in a lot of new donors that otherwise wouldn't have donated, even on the high end?
Yes. Listen to the statistic. Listen to the statistic. You ready? There were 1.1 million